Good morning. This meeting will come to order. It's a public meeting of the Commodity Futures Trading Commission, and I'd like to welcome members of the public, market participants, and members of the media who are observing this meeting today. I'm also, as always, pleased to join by my colleagues, Commissioner Johnson, Commissioner Goldsmith-Romero, Commissioner Mersinger, and Commissioner Pham. In keeping with CFTC tradition, we will recite the Pledge of Allegiance, and anyone else is welcome to join me in standing and pledging. I pledge allegiance to the flag of the United States of America, and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice. Thank you. Today, we're going to consider two agenda items, a notice of proposed rulemaking on reporting and information requirements for derivatives clearing organizations, and a notice of proposed order and request for comment on an application for a capital comparability determination submitted on behalf of non-bank swap dealers subject to regulation by the Mexican Comisión Nacional Bancaria de Valores. We'll move now to opening statements. I'll go first, followed by my fellow commissioners in order of seniority, and I'll recognize the commissioners after that. As I mentioned, we're going to consider two proposals today. First, the commission will consider the proposal for reporting information requirements for DCOs. Then the commission will consider a proposed order and request for comment on the application for capital comparability determination submitted on behalf of non-bank swap dealers. I'll share my remarks on each respective proposal in greater detail following staff presentations. But above all else, I want to express my great appreciation to our colleagues in the Division of Clearing and Risk and the Market Participants Division for their efforts on the two proposals before the Commission today. I'd also like to thank in my office, Alicia Lewis and Abigail Knopf, and my fellow commissioners and their staff for their support and work to get us where we are today. So with that, I'm now going to recognize Commissioner Johnson for any opening statement.
Thank you so much, Chair Behnam. It's an honor to join you and my fellow commissioners here today. I want to thank my team, Bruce Vekra, Gene Smith, and Matt Rowland for their tremendous efforts preparing for the meeting today. I also want to thank the staff for their commitment to the public's interest. Their dedication to advancing customer protection, market integrity, and market stability most visibly manifests itself through rulemakings, as it should. I want to thank you for your hard work today and day in and day out in service of the Commission and the American economy, and your support for the Commission's deliberation process. I am continuously impressed by your willingness to deeply engage with my office and what we learn in every instance that we meet with you. The rulemaking process serves as an engine in democratic institutions that implement and enforce congressional mandates. My friend Bobby Ade, Dean of Texas A&M Law School, long ago described this enlivening and interactive engagement as a regulatory dialectic, a continuing dialogue among regulators and a diverse spectrum of stakeholders, including public interest advocates, members of Congress, and a wide array of market participants, from large multinational institutions to end users who manage family ranches and farms. Today, the Commission will take up two important matters. The first grows out of a congressional action expanding the Commission's mandate to mitigate systemic risk concerns. The second ensures the integrity of our markets through a long-standing commitment to cooperation and collaboration with regulators in other nations around the world. In each instance, the Commission improves its visibility into markets and ensures the enduring integrity of our financial markets. The steps we take today will enable us to effectively ensure our markets, the preservation of our market integrity. We are steadfast in moving and marching forward as we adapt these regulations to address and respond to new learning, refining regulatory requests, and the advent of innovative technologies. The DCO proposed rulemaking addresses both the significance of centralized risk management oversight and concerns that, in the absence of effective enterprise risk management oversight, DCOs might create single points of failure that amplify rather than mitigate systemic risks. Payment, clearing, and settlement systems serve as a central role in financial market infrastructure. Derivatives clearing organizations stand at the center of a significant volume of market transactions, interposing the DCO for each counterparty in the contract and ensuring all transactions executed on DCO's platforms are effectively serviced. This novation centralizes risk, enables greater visibility into risk exposure of market participants, introduces uniform contractual obligations, and establishes standards for initial and variation margin, among other things. The clearing of exposures and regulation facilitate dispute resolution among counterparties, ensures minimum liquidity reserves are maintained by individual counterparties and clearing organizations, and enables the introduction of cyber risk management measures as well as governance measures that mitigate conflicts of interest and system safeguards. In addition to these benefits, DCOs arrange and provide multilateral netting of obligations and mutualized risk. These businesses provide channels for executing the largest and smallest commercial transactions in local, national, and international markets. The Dodd-Frank Act reflects Congress and regulators' perception that centralized clearing can foster greater efficiencies and promote transparency if done well. The proposed DCO rulemaking is emblematic of the evolving nature of the Commission's work. The proposal increases the effectiveness of reporting requirements and facilitates oversight. We live in a digital age that is dependent on technology and the systems and software that support it. The Commission needs the kind of information sought in this proposed rulemaking to surveil operational soundness. The rulemaking sensibly recognizes the reporting of variation margin and cash flow at the individual customer level is critical and important. Amendments to these requirements may be warranted. The rulemaking also pragmatically recognizes that DCO regulations drafted with margin in mind can be irrelevant to clearinghouses that clear and settle transactions on a fully collateralized basis. Most critically, the rulemaking process proposes a package of liquidity-related transparency amendments. Macroeconomic conditions today are marked by persistent inflation and periods of sustained volatility. Prudent risk management, and particularly the management of liquidity needs, is critical to DCO recovery and resilience. Collectively, the transparency amendments, which trigger reporting of changes to credit and liquidity facilities, and the financial health of the entities that offer them, should significantly improve the Commission's risk surveillance of DCOs and clearing members. I also want to acknowledge the second matter that's before the Commission and part of a series of matters that carefully ensures comparability with respect to international transactions. The capital comparability determination for Mexican swap dealers addresses these important issues. This proposed order and request for comment is similar to other proposed orders and requests for comments submitted or considered by the Commission earlier this year. As I noted at the time of the consideration of the Japanese swap dealer comparability determination, when the Commission first published interpretive guidance and a policy statement regarding cross-border application of certain swap provisions of the CEA, few jurisdictions had made significant progress implementing the global swap reforms identified after the financial crisis. Today, many jurisdictions have adopted effective regulatory regimes, and comparability determinations recognize that multiple approaches can achieve our financial stability goals. The Commission's capital and financial reporting requirements are critical to ensuring the safety and soundness of our regulated swap dealers. When the Commission adopted Regulation 23.106 in 2020 as part of the final swap dealer capital rules, we acknowledged undercapitalization as a core issue that precipitated the global financial crisis. Maintaining adequate capital standards requires transparency and accountability. We must continuously assess and evaluate the levels of capital and ensure accurate and timely reporting of financial conditions to preserve market stability, promote resiliency, and mitigate shocks. I support the Commission's issuance of the Notice of Proposed Order and request for comment regarding the capital comparability determination, and look forward today to hear more from the staff about both of these important issues. Thank you.
Thank you, Commissioner Johnson. We'll turn now to Commissioner Goldsmith-Romero.
Good morning. Welcome. I want to thank the staff for their very hard work on what is before us today, as well as my office. Starting on the DCO proposal, I support the Commission considering expanding requirements for clearinghouse notifications to the CFTC of cybersecurity incidents and clearing system malfunctions. Cyber attacks are one of the most persistent and severe threats facing companies today. In 2012, FBI Director Mueller warned there are only two types of companies, those that have been hacked and those that will be. And even they are converging into one category, companies that have been hacked and will be hacked again. Since then, cyber attacks have evolved dramatically. In March 2022, FBI Director Wray said that last year, 14 of 16 critical infrastructure sectors saw ransomware incidents. The rapid digitization of financial services, which accelerated with the pandemic, has led to an increase in global cyber threats, according to the Financial Services Information Sharing and Analysis Center. A 2022 survey of CISOs at 130 global financial institutions found that 74% experienced at least one ransomware attack over the past year, and 63% experienced an increase in destructive attacks designed to counter incident responses. The threat of cyber attacks is so severe that it requires the CFTC and our registrants to adapt and evolve to meet the changing threat. A major cyber incident involving U.S. clearinghouses carries the potential to create disruptions, if not short-term chaos, throughout our financial markets. Imagine the equivalent of the Colonial Pipeline attack on a clearinghouse or major clearing member. Additionally, given the nature of the technology and the pseudo-anonymity, cryptocurrencies present significant and novel vulnerabilities to cyber attacks, with more than $2 billion stolen this year alone. The CEO of Binance, which suffered a $570 million hack last month, acknowledged on CNBC that the industry has to make their code more secure, adding, quote, "In the blockchain world, whenever there is a bug, it can result in large losses," end quote. An immediate two-way flow of information will help the CFTC contain the threat and safeguard markets. The response to the Colonial Pipeline incident is instructive. The 5-day shutdown of Colonial after a ransomware attack could have been much longer, but for Colonial calling the FBI, which had an open investigation into DarkSide. The FBI had the expertise to coordinate with the Cybersecurity and Infrastructure Security Agency, give Colonial technical information and remediation techniques, identify the intrusion vector, and ultimately seize the virtual currency wallet of the criminals involved. The CFTC, too, can be helpful in navigating the aftermath of cyber incidents or systems malfunctions alongside our clearinghouses. The proposed CFTC notification requirements would account for a clearinghouse's lack of initial detailed knowledge while still requiring critical information. The CFTC could combine that information with threat information learned through federal partnerships to assess the impact of the threat, including at the clearinghouse and whether it extends to others. A clearinghouse would have to provide, in addition to notification of cybersecurity incidents, commission notifications of clearing system malfunctions. These notifications can help the commission determine the clearinghouse's ability to perform its critical market infrastructure role. We endeavor to work with clearinghouses to address cyber events and issues as they happen, not to receive after the fact notice when most of the damage has been done and when a useful coordinated response may be too late. Also, it is possible that multiple firms within an industry are subject to the same vulnerabilities, given increased reliance on third-party providers and suppliers. This is an important practical consideration. Clearinghouses must take immediate proactive steps when faced with cyber incidents, but they very often detect an intrusion or other anomaly long before they are prepared to identify a specific cause or avenue for the attack, the severity of the event, or the scope of information impacted. Therefore, I support removing the materiality requirement that an incident rise to a reporting threshold for severity or scope. Thank you to the staff on that matter, and I look forward to the discussion as well as public comment. On the Mexico capital comparability determination, I support the Commission considering efforts to safeguard the resilience of swap dealers, including through the proposed capital comparability determination for Mexico. The proposal recognizes that strong capital requirements are essential to ensure a swap dealer's safety and soundness, and that cross-border coordination with a like-minded regulator can promote financial stability. And I commend the staff for their hard work on today's proposal. One of the lessons learned from the 2008 financial crisis was the need to protect our markets from the serious risks posed by inadequate amounts of quality of capital that could serve as a buffer against risk. Critical financial reforms introduced by the Dodd-Frank Act included minimum capital requirements for swap dealers. And I note that 2 of the 3 swap dealers in Mexico are affiliates of U.S. financial institutions that were 2 of the largest TARP recipients. Dodd-Frank Act reforms led to CFTC capital requirements for non-bank swap dealers, requirements that keep our markets safe. Requiring firms to maintain a strong amount of high-quality capital helps to ensure their resilience, their ability to meet their financial commitments, and continue to perform critical market-making functions even when faced with stress events. This lowers the risk in the financial system and helps to ensure financial stability. Our capital rules are a critical pillar of Dodd-Frank Act reforms. The global nature of the financial crisis also highlighted the need for the CFTC to coordinate with foreign regulators, as swap activities in a foreign jurisdiction may have an impact in the United States. This is only the second substituted compliance determination to be considered for CFTC capital rules following our Japan proposal. So we should proceed carefully, as what we do will establish precedent. Substituted compliance is not all or nothing. The Commission can compose any terms or conditions that it deems appropriate and can continue to require direct compliance with certain CFTC rules. I strongly support the proposed condition for Mexican non-bank swap dealers to comply with the CFTC's minimum capital requirement, just as we proposed for Japan. This is one of the most critical components of the CFTC's capital requirements. It helps to ensure that each non-bank swap dealer maintains a fixed amount of the highest quality capital to meet its financial obligations without becoming insolvent. The minimum capital requirement recognizes the significant role that swap dealers play in our markets, with extensive connections to counterparties and to each other, and helps ensure their resilience. I support the conditions in the proposal that would require a non-bank swap dealer in Mexico to notify the Commission of undercapitalization or other events that may indicate financial or operational issues. I look forward to public comment on whether allowing Mexican non-bank swap dealers to submit financial reports required under Mexico's rules will ensure that the Commission has the access it needs to information to monitor the financial health and capital adequacy of these firms. Even with substituted compliance, the CFTC must ensure that we receive the information necessary to identify, evaluate, and address situations that may have an adverse impact on a firm or financial markets. The CFTC has a duty to ensure that our comparability assessment is sound and that the foreign regulator is like-minded, not only in their rules, but in their supervision, oversight, and enforcement. Therefore, a strong regulatory relationship with the Mexican Banking and Securities Commission, the CNBV, and regular continued coordination is important. I highlight and express my appreciation for the CNBV's engagement with our staff, and continued engagement will enhance our ability to work together swiftly and effectively to address any significant market stress events or other circumstances that may threaten a firm's safety and soundness. It is a priority for me to ensure that the CFTC guards against complacency with post-crisis reforms, particularly after market stresses from the pandemic and geopolitical events. Our capital rules serve as critical pillars of Dodd-Frank Act reforms to help ensure the safety and resilience of the markets and market participants from serious risk and contagion. Substituted compliance must leave U.S. markets and our economy at no greater risk than full compliance with our rules. Thank you.
Thank you, Commissioner Goldsmith-Romero. We'll now turn to Commissioner Mercinger for her comments.
Good morning, everyone. It's great to see everyone here in person today. And thank you to the chairman for calling today's meeting, to my fellow commissioners for their engagement, and for the staff at the CFTC for all of their hard work and dedication in preparing the items we're considering today. Before I get into the substance of today's meeting, I did want to mention 2 things. First, some of you may notice that there is an empty chair in the back of the hearing room that normally would be taken by Captain Roderick White. It was very sad to hear of his passing recently. He was a wonderful individual, someone I really enjoyed seeing every morning when I came into the building, and his absence will be certainly noticed, and it's definitely a loss for the agency. The other thing I wanted to mention is we're on the eve of Veterans Day, which is a very meaningful day to remember those who sacrificed for our nation. I want to thank the chair for continuing the tradition of reciting the Pledge of Allegiance at the beginning of the meeting. I think it's important to recognize the sacrifices that were made, sometimes the ultimate sacrifice that were made for our country, to ensure our freedoms, to ensure our democracy, and to ensure that we can be here today doing the work that we're doing. With that, I'll start with the notice of proposed rulemaking on reporting and information requirements for derivatives clearing organizations. I want to thank the staff for all the hard work in getting this proposal before us today. Over the past few years, the staff in DCR has noticed places where our regulations need clarifications and fine-tuning. For example, in 2020, DCR staff learned from derivatives clearing organizations and future commission merchants that it was impossible for DCOs to provide the commission daily variation margin and cash flows by individual customer accounts. As a temporary remedy, the DCR staff provided no action relief while the commission worked to consider the permanent solution. And today we're considering a proposal that, among other things, would revise our regulations so we are no longer requiring that impossible reporting. This is exactly how the process should work. You've probably all noticed that I've repeatedly called on the commission to engage in notice and comment rulemaking to fix its rules rather than to rely on temporary and often successive band-aids and workarounds such as repeated no action letters. In fact, I've issued 6 statements to that effect in my brief tenure as a commissioner. Don't get me wrong, there are circumstances that warrant staff no action relief, but that relief cannot be perpetual, and it shouldn't be perpetual. It does not absolve the commission of its responsibility to do the hard work. So I'm pleased today that we are considering fixing unworkable rules through notice and comment rulemaking. Thank you to the staff of DCR for your important role in identifying issues and proposing permanent solutions. I think the proposal before us today, it also makes some additional changes to our regulations applicable to DCOs, including adding some new reporting fields into the DCO's daily reporting requirements. We should always be mindful of the data we are collecting here at the agency and ensuring that the collection is narrowly tailored to accomplish the mission. For that reason, I am anxious to see the comments that we receive related to some of the aspects and proposals of these new reporting fields. Switching to the capital comparability determination for Mexican Banking and Securities Commission, much like the Japan determination, we considered at the last open meeting. Here we are today looking at reporting regimes and how the Mexican Banking Securities Commission and their regime is comparable to CFTC's swap dealer capital and financial reporting requirements, and whether those CFTC registered non-bank swap dealers may comply with our requirements by complying with their home country's requirements subject to certain conditions. Our markets are global, and international cooperation and deference to comprehensive, comparable home country regulation is essential. Any analysis of whether one country's regulation is comparable to another's should be a principles-based analysis that focuses on whether each country's regime achieves comparable outcomes to the other country's regime. When the G20 leaders met in Pittsburgh in 2009 in response to the financial crisis, they recognized that the global nature of the derivatives markets, and they explicitly committed to taking action to raise standards together so national authorities would implement global standards consistently in a way that would ensure a level playing field and avoid fragmentation of markets, protectionism, and regulatory arbitrage. The US Congress memorialized these commitments through the Dodd-Frank Act, and the CFTC has implemented a regulatory framework that respects these commitments. In accordance to our regulations, 3 CFTC registered non-bank swap dealers licensed with the Mexican Banking and Securities Commission submitted an application requesting that the commission determine that Mexico's capital adequacy and financial reporting requirements and related financial record keeping and reporting requirements are comparable to the corresponding CFTC regulations. The proposed order we are considering today reflects countless hours of work by our staff in the Market Participants Division. I know this has been a complex and really labor-intensive undertaking, and I am very appreciative of all the time and effort the MPD staff has put into this proposal. This is our second capital comparability determination we've considered this year, and I look forward to considering others very soon. With that, I just want to say thank you again to the staff of DCR and MPD. Thank you to my staff, Libby Master Giacomo, Terry Arbit, and John Mark Buffa for helping and making today come together and ensuring that I had everything I needed for today. Thank you to the staff that makes this open meeting happen, not just DCR and MPD, but also the Office of General Counsel, Office of Chief Economist, Secretariat's office, and of course our technology and logistics and operations team. We could not do this without each and every one of you. So again, thank you so much, and I look forward to hearing more about the proposals today.
Thank you, Commissioner. Appreciate your comments about Captain White. He certainly will be missed. And also about Veterans Day, we had a wonderful event here a few days ago to honor all veterans, but certainly those here at the CFTC, and we have many of them, and we're very proud of that service that they've committed to our country. So with that, I'll turn to Commissioner Pham.
Thank you, Mr. Chairman, and let me begin by thanking my team, particularly Megan Tente and Keegan Ames, for their assistance in analyzing these rules today. I'd also like to echo wholeheartedly Commissioner Mersinger's comments, recognizing the service of Captain White and all our veterans. I'd like to share a little story, actually. Captain White remembered me all those years that I would come and have meetings here at the CFTC. And on my first week as a commissioner, he welcomed me back as a commissioner and remembered me from all those years. And it really was special for me. So I'm really pleased that we're able to recognize his memory and his service. I also would like to thank the rule teams who spent months developing the proposals for our consideration today. Regarding the proposed comparability determination for Mexico, I'm so pleased that today we're continuing the hard work that started with Dodd-Frank. Substituted compliance is a critical next step in fully implementing margin and capital regimes for our global derivatives markets. But making progress in this area can be challenging and resource intensive. I'd like to acknowledge the hard work of the staff in the Market Participants Division for analyzing these foreign regulations and working with their regulatory counterparts to reduce cross-border regulatory burdens. Thanks to them, we are making progress in minimizing operational complexity that can otherwise increase risks and costs for the global markets and result in less effective risk transfer. I hope that MPD's recent proposals in this area serve as an example to our future rulemakings as well as to other jurisdictions to follow suit in mutual recognition, and I encourage the staff to continue actively pushing forward additional outstanding applications for substituted compliance. With respect to the DCO reporting proposal, I am also pleased that we will be considering a proposal to primarily fix a reporting issue for the CFTC's derivatives clearing organizations. Strong, resilient DCOs promote the efficiency and stability of derivatives markets. The CFTC's oversight of DCOs helps ensure they provide a crucial risk management services and reduce counterparty risk in the financial system. Sometimes our rules don't work the way we intended. The proposal today from the Division of Clearing and Risk acknowledges an issue discovered with DCO reporting and, importantly, proposes to fix it. DCR's proposal serves as an example to the Commission on identifying a problem and proposing a solution without taking too long. And most importantly, the proposal helps ensure that DCR receives accurate data to effectively oversee its registrants. With that, I would like to thank all the CFTC's hardworking staff who made today's open meeting possible, and I'd like to turn it back over to the chairman.
Thank you, Commissioner Pham. So in a few moments, I'll invite CFTC staff panel to begin their presentation on the first matter on today's agenda. After the presentation, we will formally open the floor to commissioners for their questions, comments, and discussion on the matter presented. And then we will conclude with the commission's decision with a vote on the matter presented. That sequence will be repeated for the second matter on today's agenda as well. Each of the votes conducted in this meeting will be a recorded vote, and the result of each vote approving a commission document, should that be the outcome, will be published with the document itself in the Federal Register. So at this point, I ask for the commission's unanimous consent to allow staff to make technical corrections to any documents approved at this meeting as necessary to prepare such documents for publication in the Federal Register or to otherwise finalize them.
So moved.
Second.
Hearing no objections, consent for staff technical corrections is hereby granted by the commission. This time, I'd like to welcome staff from the Division of Clearing and Risk for their presentation on the first matter on today's agenda, a notice of proposed rulemaking on reporting and information requirements for derivatives clearing organizations. Presenting to us will be Clark Hutchinson, Director of the Division of Clearing and Risk, Eileen Donovan, Deputy Director of the Clearing Policy Branch in DCR, Parisa Nori, Associate Director in the Clearing Policy Branch in DCR, and August Imholtz, Special Counsel in the Clearing Policy Branch in DCR. So with that, please proceed.
Thank you. Excuse me. Thank you. Good morning, Mr. Chairman. Good morning, commissioners. Pleasure to be here again in front of you. Also, good morning to staff. This morning, my staff and I will be presenting a proposal to amend certain reporting and information requirements applicable to derivatives clearing organizations, or DCOs as we refer to them. I would like to also recognize staff behind me, with particular recognition to Eileen Donovan and her team in DCR, including Elizabeth Aramili, Brian Baum, Eileen Schottner, August Imholtz, Parisa Nori, and Tad Parley for their work in this rulemaking. But it's not just DCR alone. We'd also like to thank other branches within the commission that helped with this rulemaking. Also in DCR, Richard Haynes and Julie Moore and their teams, but also our colleagues in the Office of the General Counsel, Carlene Kim, for her team, and our colleagues in the Office of the Chief Economist, Scott Mixon, and his team. Thank you all again. With that, I'm going to turn this over to August, and when he is through making the presentation, we'd be happy to take questions from all of you. Thank you. And with that, August, I turn it to you.
Thank you, Clark. Good morning, Mr. Chairman. Good morning, commissioners. It's a pleasure to be here. This proposed rulemaking updates and amends the information that DCOs are required to provide to the commission, as well as information that certain types of DCOs must make public. As you know, the proposed rulemaking does not break any new ground in terms of commission policy. It doesn't address exciting new products or new platforms or anything like that. Despite that, I still think it's an important rulemaking that deals with an important subject because of what it does cover. It may be helpful to speak very briefly at a high level about the Commission's supervision and oversight of DCOs generally. What I want to discuss is a key element of supervision and oversight that seems like it's often taken for granted, but can be critically important to the Commission's mission, especially in times of market stress or when a particular firm experiences trouble. Of course, given the discussion this morning and the title of the rulemaking and your staff's work, you know I'm referring to information. Information is the lifeblood of our supervision of DCOs. Timely information, accurate information, often taken for granted, but terribly important for us to do our jobs. This is just one staffer's opinion, but I think the events of this week highlight how important it is for regulators to have timely and accurate information about markets and market participants. Generally speaking, there are several reporting streams that apply to DCOs. There's some information that DCOs must report to the Commission daily. There's other information that's reported periodically on a quarterly or annual basis. Other information is reported on an event-specific basis. When an event happens at a DCO, the DCO is required to report it to the Commission. Additionally, separate from the daily periodic, and event-based reporting requirements, there also are requirements that mandate that DCOs provide certain information to the commission before the commission will approve the DCO's plans to take certain action or enter into a certain type of arrangement. Separate from the information that DCOs are required to report to the commission is the information that DCOs are required to publicly disclose for the benefit of market participants, including customers and clearing members. This rulemaking is an effort to improve the existing reporting and information requirements that the commission regulations impose on DCOs. This proposed rulemaking is the result of the collective experiences of DCR staff in dealing with the existing reporting and information disclosure requirements, and then attempting to improve them on a going forward basis. First, I would like to touch on reporting for system safeguard issues. Regulation 3918 is the system safeguard rule for DCOs. It requires the DCO to address operational risk through controls and procedures. And here's the important part for our discussion today. And through automated systems that are reliable and secure. In connection with that, 3918G requires a DCO to notify the commission of certain types of events. Basically, we want to know about those events that indicate that a DCO's automated systems may not be as reliable or may not be as secure as the DCO intended and as the commission would expect. Currently, Regulation 3918G1 implements this requirement. It requires that a DCO promptly notify DCR staff about any hardware or software malfunction, security incident, targeted threat that materially impairs or creates a significant likelihood of material impairment of automated system operation, reliability, security, or capacity. So we're proposing to split this requirement into two separate requirements, one that covers malfunctions and errors, and the other that covers security incidents and threats. With respect to malfunctions and errors, we are proposing to amend 3918G1 so that it specifically just covers those items. The proposal will require that a DCO promptly notify DCR of any hardware or software malfunction, and this is new, or operator error that impairs or creates a significant likelihood of impairment of automated system operation, reliability, security, or capacity. Note that operator error is being added to this section. A fat finger mistake or other accidental human input into an automated system can do just as much damage as a system malfunction. I mentioned we're splitting the provision into two parts. The other half of the current version of 3918G1 is the part that deals with security incidents and threats. The proposal includes a completely new version of 3918G2 that will address that. Existing 3918G2 is renumbered as G3, and we're not making any changes. The new version of G2 will require that a DCO promptly notify the division of any security incident or threat that compromises or could compromise the confidentiality, availability, or integrity of any automated system or any information, services, or data, including but not limited to third-party information, services, or data relied upon by the DCO in discharging its responsibilities. In connection with both of these amendments, we also are proposing to amend a different part of 3918, subsection A, which contains the definitions. We are proposing to define the phrase hardware or software malfunction and also define the phrase automated system. One last thing, the current version of 3918G requires notifications for malfunctions, incidents, and threats that materially impair an automated system. The proposal removes that materiality threshold for both malfunctions in amended G1 and also for incidents and threats in proposed amended G2. Moving on from system safeguards reporting, next we will discuss daily reporting by DCOs. Daily reporting is, I think, one of the most important supervisory tools we have within DCR. Honestly, it's difficult to overstate its importance. The information that DCOs report on a daily basis is used for a variety of purposes. For example, it's the basis of the DCR clearinghouse report that is circulated to your offices and to senior staff within the divisions. It's also the basis for any special reports or ad hoc projects that are prepared sometimes at commission request, sometimes generated within DCR that are prepared by DCR's risk surveillance branch. It's important to note that all the information that DCOs submit to the commission as part of their daily reporting, as well as part of the other reporting requirements, is treated as confidential within the commission. So with respect to daily reporting, Regulation 3919 C1 requires a DCO to report to the commission on a daily basis initial margin, variation margin, cash flow information, and position information for each clearing member by house origin and by each customer origin. A few years ago, we amended this regulation to require a DCO to also report all of that information, IM, VM, cash flows, and position information by individual customer account as well. Unfortunately, we later learned that some DCOs do not have the ability to break out variation margin and cash flow information at the individual customer account level. That problem, again, is just the inability to break out those two pieces of information at the individual customer account level. It only applies to VM and cash flows. DCOs are able to report initial margin and position information at the individual customer account level. The industry requested and the commission granted no action relief from the requirement that DCOs report VM and cash flow information at the individual account level. That no action relief was granted first in letter 2101, and then it was renewed in letter 2131. We are proposing to eliminate from the rule the requirement that DCOs report variation margin and cash flow information at the individual customer account level. The proposal would essentially codify the existing no action relief that's in place. There's another part of the proposal is to require DCOs to daily report their daily backtesting results. One of the most crucial risk management tools that a DCO uses is its margin model. Consistent with the importance of the margin model is Commission Regulation 3913 G7, which requires a DCO to perform daily backtesting of its margin model. We are proposing to add to 3919C the requirement that the DCO include in its daily reports the results of its daily margin model backtesting. Next, we'll talk a little bit about the reporting guidebook. I know we just discussed it a moment ago, but I think we need to sort of touch on it again. And that's the specific daily reporting requirements in 3919C1. Again, C1 requires DCOs to report initial margin, variation margin, cash flow information, and position information. Those may seem like specific concepts, but to actually implement them, it becomes quickly clear how broad those terms can be or can be interpreted. So to interpret this requirement when it was adopted in 2011, to implement this requirement, DCR, after consulting with the DCOs, developed and distributed to the DCOs a reporting guidebook. The reporting guidebook contained detailed instructions and technical specifications for reporting under 3919C1. Basically told them how to report IM, VM, cash flows, and positions. The reporting guidebook was designed to ensure that all DCOs were reporting a standard set of information in a uniform manner. This was necessary because we had to make sure that the information actually was useful to the commission in its supervision and oversight of DCOs. DCOs have been submitting their daily reporting pursuant to the reporting guidebook for about 10 years, a little more. During that time, the guidebook has been revised and updated several times. Each time, DCR staff consulted extensively with staff at the DCOs. So you can imagine, as a result of those revisions and updates, the reporting guidebook has grown longer and more comprehensive. Given the development and expansion of the guidebook over the years, DCR staff thought it would be beneficial and appropriate to codify the DCR reporting guidebook within Part 39, and that's what this proposal does. It codifies key components of the existing guidebook, which are set forth as fields in the guidebook, and basically transports those fields into a new appendix to Part 39. So in addition to the existing fields in the guidebook, we also are proposing to add directly to the new appendix several new fields that do not currently appear in the current version of the guidebook. These new fields are intended to further implement the existing daily reporting requirements under 3919C1. More importantly, as a practical matter, they are intended to enhance the Commission's ability to conduct surveillance and oversight of DCOs. For example, we are proposing to add additional new fields to the appendix so that DCOs that clear interest rate swaps must report Greek ladders and yield and rate curves. We also are proposing new fields that require that a DCO include in its daily reports timing information about variation margin calls and payments. I feel like we've covered the major elements of the proposed changes to daily reporting. So I'd like to shift gears and talk briefly about the public information requirements for fully collateralized positions. Fully collateralized positions are exactly as the name suggests. They're positions where the collateral on deposit, whether it be funds or the underlying commodity, is enough to cover the maximum potential loss that a counterparty could incur. Fully collateralized positions present a very different risk profile compared to margin positions. In fact, they do not expose DCOs to the same risks that margin positions do. A number of the Part 39 rules for DCOs that make sense for margin positions do not make sense for fully collateralized positions. Some of those requirements are inapplicable or unnecessary. In recognition of that fact, in 2020, the Commission adopted certain carve-outs for fully collateralized positions. This proposal adds a couple more carve-outs for those positions. Specifically, under the proposal, a DCO that clears fully collateralized positions would not need to comply with certain requirements that apply to traditional margin positions. A DCO that clears fully collateralized positions would not have to comply with the 3921C requirement, which mandates that a DCO publish on its website information about its margin setting methodology or the size and composition of its financial resource package. This is because a fully collateralized DCO is excused from both of those underlying requirements. Under the proposal, a fully collateralized DCO would not need to publish on its website a list of its non-FCM clearing members that clear only fully collateralized positions. For the fully collateralized DCOs, those members currently tend to be individual retail participants, and staff believes that publication of their names does not further a regulatory purpose. Lastly, under the proposal, fully collateralized DCOs would be excused from the requirement, which is in renumbered 3913H53, that DCOs include in their rule books provisions that require clearing members to maintain current risk management policies and procedures. that sort of sums up the proposed changes with respect to fully collateralized positions. There are a number of other items within the proposed rulemaking that I would describe as cleanup. They're basically minor improvements or revisions. There's one that I think is worth mentioning briefly, and it relates to commingling customer funds. Under Part 39, a DCO is allowed to commingle customer positions and associated funds from 2 or more of 3 separate account classes. The first being futures and options, the second being foreign futures and options, and the third being swaps. And a DCO is permitted to commingle those positions in either its customer futures account or its customer cleared swaps account. Now, a DCO has to obtain commission approval before it can commingle customer positions and funds from different account classes in any single customer account type. Regulation 3915B2 sets forth the procedures a DCO must follow to obtain that commission approval to commingle customer positions. It contains a list of information that a DCO must provide when seeking approval. Over time, staff has discovered that some of the information is unnecessary, or even it's information we already have. And we've also discovered that other information, we are not receiving other information that could be helpful. So we're refining the information requirement related to seeking approval to commingle customer positions. I think that sums up the high points of the rulemaking. In conclusion, I hope this brief overview has been helpful, and we're happy to answer any questions you have about the proposal.
Thank you, August. That was excellent. Appreciate the time and the very thorough presentation to the Commission. To formally open the Commission's discussion and consideration of the matter just presented, I'll now entertain a motion for the approval and issuance of the notice of proposed rulemaking on reporting and information requirements for derivatives clearing organizations as presented in the voting draft circulated to the Commissioners.
I so move.
Second.
It's been moved and properly seconded that the Commission approve the notice of proposed rulemaking and issue it for publication. The floor is now open for the Commission's deliberations on this matter. I will begin and then go in the order of seniority. And as I said in my brief opening statement, I'll make some comments specifically about the proposed changes and then ask a few questions of the staff. The Commission last amended these requirements in January 2020 and is revisiting them today in order to address certain issues identified by market participants and through the Commission's experience with DCO compliance with the amended reporting and information requirements. The proposed amendments either codify existing staff no action letters and Commission practices or provide further clarity. Additionally, the Commission is proposing to provide the Director of the Division of Clearing and Risk with specified delegated authorities in support of efficient DCO oversight. I fully support the proposed rulemaking, which aims to provide greater transparency, clarity, and certainty to our DCOs and market participants regarding our reporting requirements and streamlines how the Commission receives the information necessary to supervise DCOs. Periodic stock takes and updates of our regulations based on our experience and ongoing compliance concerns further mitigate unintended consequences and ensure that our regulations are operating as intended. Look forward to the public submission of comments and feedback on this notice of proposed rulemaking. And again, many thanks to the Division of Clearing and Risk and all the staff involved, both in DCR, but as was mentioned, OGC and the Chief Economist for their hard work and effort in bringing the proposal to us today. With that, before just a few questions, August, I just want to echo and second your comments about the events of this week and how this particular proposal that we're considering right now, although it may appear minor, is in fact the opposite. It is quite significant. It has a significant impact on our ability to collect data, to surveil some of our most important and systemically important, I think most importantly, registrants. And in a time of advancing technology and evolving market structure, our ability to adapt and change our rules in a nimble fashion is more important now than it ever has, I think, in the history of this agency and markets as well. So this is a crucial step, and one that hopefully the public will comment on and give us a little bit of guidance of potentially what we can do to even further improve it to make sure that we're doing our job and fulfilling our mandate. So with that, quickly, August, and I assume this question will be for you. You mentioned 3919, and just the fact that the NPRM is proposing to codify existing reporting fields, specifically for the daily reporting requirements, which you mentioned, or IMVM cash flows and positions that don't currently exist in the guidebook, which you mentioned. And I guess on the one hand, codification, and I commend and agree with Commissioner Mercinger on her points about the importance of codification and certainty and getting public input. But does this limit us in any way, to my point earlier, as we are going to see markets evolve and potentially different data fields become important or even irrelevant? How will this impact our ability to change data fields or the requirements in the future?
Yeah, thank you, Mr. Chairman. That's a very fair question, and it will affect our ability to change the requirements, to change the data fields. But that's kind of the point. We think it's important that these provisions be sort of considered part of the rule, formally made an appendix, and subject to notice and comment on a going forward basis. That said, the guidebook has evolved over the years, and we anticipate that it would perhaps continue to evolve, but perhaps also at a slower pace. And to your point about the events of this week or any other, market event that merits additional consideration and study by the commission, even on an expedited basis, 3919, I think it's C5, provides that a DCO shall provide, upon request by the commission, any information related to its business as a clearing organization. So in the event that we need additional information on any given day, then we have the ability to get it.
Thanks, August. Quick second question about the provisions regarding fully collateralized positions, and appreciating, again, another policy that's relevant to some of the things that we're experiencing this week, but appreciate the policy decision to make exclusions for fully collateralized positions because of the nature of fully collateralized positions and the risk profile that fully collateralized positions present as opposed to leveraged positions. Just want to confirm, for a DCO that potentially has both fully collateralized and margin positions, how are we ensuring a bifurcation of the requirements and ensuring that these exemptions don't apply to a DCO that may offer both fully collateralized and margin positions?
Right. Another good question. The rule only applies to those positions that are fully collateralized. So it applies on a position basis as opposed to a DCO basis. I could be wrong. I don't think we currently have any DCOs that are both margined and fully collateralized. But the pace at which these markets change, as you know, it wouldn't surprise me if we had one of those sooner rather than later.
Yep, that's good point, and one that I think we should keep in mind, but it's good to hear for the record that we are distinguishing between the two if there is a scenario where a DCO would have both fully collateralized and margin. The last point, last question, no action letters, 2131, I think, and 1915 regarding reporting. If we can get to a final here after the public comment period, again, just for the record, assume that these no action letters would be moot at that point.
1915 will be moot. They both will be moot. 1915 did not have a time period, but 2131 did. I think it expires in late January, so it's likely that the industry will request that we extend that. I can pretty much guarantee it. But then once the final rule is adopted, you're correct. Both of them will be moot.
That's great. And I want to echo Commissioner Mercinger's comments, support her position about codifying no action letters. It's an important responsibility of the agency, but it does take time. It takes obviously the process to get these through, to draft them, to propose them, have public comment, and certainly my intention to get this done as chair. And hopefully over the next few years, we'll see a string and a series of existing no action letters codified across all divisions, but do appreciate the work of DCR to make this effort and hopefully get this across the finish line and put these into the code and our regulations. So with that, thanks for your presentation, August. It was excellent. And your responses to my questions. I will now recognize Commissioner Johnson for her comments and any questions she has for staff.
Thank you so much, Chair Behnam. August, what an amazing and impassioned presentation. I learned a tremendous amount from the process of preparing for this, for today's open meeting. And it was wonderfully delightful to have you articulate a framework for understanding a number of transitions, if you will, from where we were in 2020 to where we are now. I very much liked your response to the chair's question, and I quote, "The pace at which things change, things in markets change," right, is the starting point of your sentence there. And I think that's a brilliant observation. I think it really illustrates the motivation for our being here today and the thoughtfulness around the regulation that has been proposed. I'm pleased to support issuing the proposed report and information reporting and information requirements rulemaking for comment. I welcome comments from derivatives clearing organizations, specifically in that regard. I conceptually support the proposed amendments to Regulation 39.18 regarding derivatives clearing organizations' obligations to report to the Commission instances of automated systems impairment or related operational errors without any linkage to a materiality standard. The proposed amendments to Regulation 39.18 also extend reporting requirements of security incidents to services offered by third-party vendors. I support establishing a bright line for reporting that triggers and incorporates third-party incidents into the reporting process. In jettisoning the materiality standard, the proposed rulemaking emphasizes the existence of instances where staff has learned of an occurrence it considered to be readily material, but the relevant DCO did not. Such instances are fertile ground for the issuance of guidance because they apply regulatory standards to observable commercial practices. Opportunities to provide such guidance should not be missed. In general, reporting requirements should be accompanied by clear guidance to make any final rules truly workable. I also support the rulemaking because it's responsive to active no action relief, as the chair just described, and its recognition that certain requirements should rightly not apply to DCOs that clear and settle fully collateralized derivatives transactions. In 2020, the Commission amended 39.19C1 as described, which requires daily DCO reports on initial margin and variation margin, cash flow, and position information for clearing members by house and customer origin. The Commission's amendments require DCOs to also report variation margin and cash flow at an individual customer level on the supposition that the data was readily available. Today's actions illustrate the Commission's agility, flexibility, and the potential for us to engage in a dynamic regulatory environment. Where information was not readily accessible or reportable, or no action relief had previously been offered, we have taken action today or take action today to address these outdated assumptions. The rulemaking is now proposing to effectively obviate the need for no action relief by removing the requirement that a DCO report daily variation margin and cash flows at the customer level. I support adapting substantive requirements or exemptions away from no action letters and to codified rules when sensible and appropriate. Finally, two last quick notes. The rulemaking is proposing amendments that recognize the prevalence of DCOs that clear and settle fully collateralized transactions and acknowledging distinctions between these DCOs and others. Most critically, and I have a few questions from my first point and my last point in just a second. Most critically, the rulemaking proposes a package of liquidity-related transparency amendments that I fully support. The proposed amendments to Regulation 39.19 would implement enhancements to the reporting of clearing members' variation margin calls and DCO credit and liquidity funding arrangements. The proposed amendments also include reporting triggers related to the financial health of the entities providing these facilities. Collectively, these amendments would significantly improve the Commission's risk surveillance of DCOs and clearing members, particularly with respect to liquidity developments that are critical for resilience and recovery. With that, let me just ask a couple of quick questions, one about the first point I made and one about the last point that I made. So the first point I made was about automated systems. In the proposal, it's noted where DCOs, that we would be thoughtful about the extent to which DCOs automated systems might be materially impaired. It was helpful to hear you, August, describe the expansion in light of continued adoption and expansion of the adoption of technology to instances not only where I think we described there would be an error relating to software or hardware, but fat finger errors as you described them. I'm thoughtful about the extent to which the definition of automated systems is as expansive as it might possibly be. And so I'm hopeful that you can just share responses to a few quick questions. If the rules are finalized, once the rules are finalized, I'm curious to know the extent to which, or in the context of receiving comments, you anticipate proposals to amend the definition of automated systems. So as currently drafted, the definition of automated systems encaptures hardware and software, computers, and ancillary equipment. I'm curious to know if it might be worth thinking carefully about including autonomous and algorithmic-driven processes or systems. In part, my suggestion comes directly out of a few years of studying NIST's framework and the extent to which cybersecurity protections, particularly for exchanges and clearinghouses, can be critical to the functioning of our global financial infrastructure. In the context of those studies, I spent extensive time exploring the types of cybersecurity attacks that might arise internally due to malware or externally due to a DDoS attack. And so I'm just thoughtful about being as all-encompassing as possible in describing exactly what we mean by automated systems to effectuate the farthest reach of the rule. So I'll pause with that question first.
That's a very fair point, Commissioner. And it's well received. Staff's view is that the definition is sufficiently broad. If it's not, I really hope we receive comments that can educate staff as to where it can be improved. And the reason we think that is because, and I am echoing, and I'm the conduit for the views of some of our subject matter experts in this area. I can barely work my iPhone. So our view is that algorithms, AI, other types of the newer technologies, they still have to live somewhere on the system, and we think they live in the software, and that the term software covers that. If we don't have that right, we really hope the commenters let us know, because we share, we all share the same goal with respect to this provision.
That's fantastic. And I stand with you, beside you or behind you in support of soliciting those comments. There are certainly some, other than myself, who are far better versed in appreciating the interplay between automation, automated systems, AI, software and hardware, and the systems and processes that different platforms have adopted or implemented. So my thought is really just to welcome that conversation in the comments, and I'm hopeful that my office and the staff can engage in a colloquy regarding sort of what we receive from industry experts. One other quick question. The proposal amends the Commission's commingling regulation, Regulation 39.15B2. To be precise, can you explain the interplay between commingling customer funds and portfolio margining? And I actually do have a third question, not directly related, but I'll pause there. So the relationship between commingling customer funds and portfolio margining.
I'm wondering if Eileen or Clark wants to take that one.
Commissioner Johnson, thank you for the question. So, I mean, our rules treat them as separate concepts. I mean, obviously, that's usually the goal of commingling is ultimately portfolio margin. But the provision we're talking about here is specifically just the result of the fact that Section 4D otherwise requires futures and swaps to be held in separate accounts. So Regulation 3915 says that if the DCO wants to just move between the two accounts, they can just file a rule for approval by the Commission under 40.5. Portfolio margining is handled separately in a provision that, I apologize, I know it's in 3913. I can't remember the exact provision, but basically there has to be a demonstration that there is a correlation between the positions before margin reductions can be taken. So while we require in the commingling submission that the DCO make a representation that if it does any portfolio margining, it will do it in accordance with the standard in 3913, it is not expressly approving the portfolio margining. That is something that Richard and his team and risk surveillance would certainly want to look at if there's any portfolio margining being done and whether the reductions are appropriate.
Thanks so much, Eileen. Very helpful. I turn to the chair.
Thanks, Commissioner Johnson. And seeing that you've concluded your remarks, now I recognize Commissioner Goldsmith Romero for the purpose of making any comments and asking questions.
Thank you, Chairman. Let me start where Commissioner Johnson was, because this goes to an issue that we previously discussed. I agree with Commissioner Johnson looking at the definition of automated system and having that be all encompassing. And I know we discussed, and I suggested sort of adding, algorithms, AI, and other technology. And I do look forward to public comment on this and to see if this is covered. I understand the balancing act that you have to do to say, well, if we start to list out some, that may fit into another bucket, is that the right approach? And I think that's tough. It's a challenge, and I'm glad we have the opportunity to have public comment. I also want to make sure that we are evolving and adapting, and I don't want to get into a situation where someone we're expecting notification from doesn't give. So I am very interested in seeing the public comment and engaging more with your office and with Commissioner Johnson's office and my other fellow commissioners on this. And I appreciate you raising that, Commissioner Johnson. On that same line, I'm significantly concerned about a cyber attack and customer funds or positions being compromised. And so we looked at sort of what is compromised. I'm thinking about how we can adapt and evolve given digital assets. Do you share the same concern, and how is that addressed in the proposed rule, and should we spell that out?
Yeah, thank you, Commissioner. We appreciated and enjoyed the engagement with your office this week on these issues, and we received a lot of benefit from it. It forced us to sort of rethink some things and look at them with a sort of fresh lens. And as you say, like cyber attack was described as one of the nightmare scenarios, and we're just keenly aware of the potential for that nightmare. Our view is that the existing regulation covers a hack, and specifically that is covered under the term security incident, because that term it refers to cybersecurity, and that a hack where either customer funds, I don't even like to say it, but customer funds were stolen or positions were altered somehow would be an incident that jeopardizes sort of every aspect of the automated system. It jeopardizes its operation, its security, and its reliability, and ultimately the integrity of the data. So we feel like a hack covers or basically touches all the parts of the rule. But if commenters disagree or if there's a way to improve it, we would very much appreciate hearing that.
Thank you for that. What has been the experience of the consistency of clearing agencies actually reporting these cybersecurity incidents or malfunctions under the existing rule? Have you been getting the notifications that you would expect to get? I believe when we talked, the experience was something like half the firms reported and half not, if I have that right, but I'll ask you.
I'll start, and then if I go off track, I think Clark will jump in. We've actually had pretty good experience. I'm not sure it's 50-50, and Clark or one of my colleagues maybe will speak better to that, the breakdown. But I think in fiscal 22, if that was the last fiscal year, we had 120 reports from DCOs, and there's some DCOs, as you observed, they're excellent, just A+. Others, we feel like they could be a lot better. And we think the hang up is the materiality standard, because there have been instances where staff, and we're talking about the subject matter experts on staff, not me, the folks in Julie Moore's group, learned of something later from a DCO and said, why didn't you report this? And that's the situation that we are trying to address by removing the materiality standard.
Thank you for that. I appreciate that, and that's why I certainly support removing the standard. When you haven't gotten that notice that you expected, where you felt it's material, how did we hold the clearinghouses accountable? Was there supervisory action or enforcement action?
That is a great question. And I do not have an answer to that, but we'd be happy to, because that question will remain an excellent question after this meeting. So we'd be happy to re-engage with your office on that.
Thank you. I appreciate that. And
I think, sorry to interrupt, but I think I could add something to that. I think it's typically come up in the context of exams where Julie and her team have discovered that there were incidents that happened that were not reported. So I think typically then that becomes a finding in an exam, and then Julie prescribes some sort of corrective action.
Thank you. And I want to make sure that we are taking into account the evolving threat landscape. I mean, obviously, a lot has changed in terms of cybersecurity threats over the last few years. Sort of what approach did you take, and how did you take into account the evolving threat landscape?
I think so. When we started working on the reporting rulemaking, it all started with the VM and cache flow issue for individual customer accounts, and then it was short. It was like an 8-page rulemaking, and now it's 80 or something. And it kind of reminds me of the 4 most expensive words in home renovation while we're at it. So something came up, an issue came up, and it caused us to discuss system safeguard reporting with the exams branch and the subject matter experts that work there. And the result of those discussions is the proposed changes you see before you today. So we think that the rule is sufficiently broad as crafted to address sort of existing technology and sort of any evolution of the existing technology. And I say that based on my reading of the rule and the our engagement with exam staff, the subject matter experts, we certainly didn't. The lawyers didn't say no to them about changing something there, if that makes sense.
And when do you expect clearinghouses to notify you of a cybersecurity incident or malfunction, and why is that timing important?
Yeah, we basically expect them to notify us immediately. And that's how it's worked in practice. When we do receive the notification, we pretty much either receive it or we don't. And basically we think the existing process works pretty well, because generally the folks in the clearinghouse will pick up the phone and they'll call Julie Moore, Deputy Director of Examinations. And we know that the clearinghouse may in fact be under tremendous stress at the time. So we keep it short and sweet and let them return to firefighting. And if we feel like we haven't received notice timely, we certainly let them know. But I don't think Julie's had any complaints about the timeliness of the notice.
Thank you, August, for being a good sport through all my questions and answering them so comprehensively and thoughtfully. I don't have any additional questions. I do want to make a comment. The threat of cyber attacks has evolved to be so severe, as is the damage that can flow from a clearing system malfunction, that it's critical that the commission hold clearinghouses accountable to the new notification requirements if and when they're enacted. And this can include through supervisory methods and enforcement actions for reporting failures and delays. Accountability is critical for all clearinghouses, but that's particularly important because of the existence of new clearinghouses now and in the future, including cryptocurrency firms not used to being regulated by a US regulator. While established clearinghouses may be familiar with working with the CFTC to address cyber events and system malfunctions as they happen, new entrants to this space may be less familiar with the requirements and process. Holding all clearinghouses accountable to these new requirements, if and when enacted, will be critical to containing the impact of any threat. In my experience as a longstanding law enforcement official, clear rules provide the strongest accountability and strengthen the ability to bring a successful enforcement action. Under our proposed rule, clearinghouses would report incidents without having to perform a materiality analysis, which I support. Clearinghouses would instead follow a list of notice triggering events, I'll call them. And the proposal states the commission believes that both DCOs and the division will benefit from having a clear, bright line rule. I like clear, bright line rules too. I'm interested in public comment on whether the proposed triggering events are sufficiently clear and complete to adapt to the ever-evolving cybersecurity threat landscape and the ever-evolving nature of technology. I'm also interested in public comment on whether the proposed rule adequately addresses risks specifically related to digital assets, including, for example, a cyber attack that compromises customer assets or property, which is, as you said, August, a nightmare scenario. And I'm interested in whether the proposal ensures sufficient accountability and enforceability. Under our existing rule, clearinghouses are required to report incidents promptly. I'm interested in public comment on whether the promptly timing requirement for notifications is sufficiently clear as to when the CFTC expects notification is complete and sufficiently evolves and adapts to the changing threat landscape, changes in technology, and risks with digital assets. I'm also interested in public comment on whether the existing promptly timing requirement ensures sufficient accountability and enforceability. Given the severe threat and the pace at which things in markets change, as you said, August, I'm interested in public comment about whether the commission should complement the existing promptly timing standard with some defined time period, like, but no later than 24 hours after discovery or other time frame, in order to hold accountable through supervision or enforcement those clearinghouses who delay notification until well after 24 hours, and perhaps only after an investigation. However, I want to be clear, I would not want a defined time period provision to provide a reason for a clearinghouse to delay immediately notifying the commission and waiting until just prior to the 24 hours. The SEC has proposed a 4-day bright line rule for public disclosure of material cybersecurity incidents, specifically stating that an investigation of the incident shall not delay disclosure. I'm interested in public comment on whether it is clear that the promptly timing requirement means that an investigation shall not cause delay in notification, and if not clear, whether the commission should explicitly address that in the final rule. And I encourage staff to continue evaluating ways to enhance our regulatory regime to mitigate this threat. Thank you.
Thanks, Commissioner Goldsmith-Romero. Excellent questions, and share your sentiment about the importance of these issues, the new risks, and making sure we get this rule right. So look forward to public comment on those specific issues you raised in your statement. Turn over to Commissioner Messenger for your questions.
Thank you. And just to quickly reflect on what Commissioner Goldsmith-Romero said, promptly is somewhat subjective, or can be interpreted subjectively. And so I do agree, we should, hopefully we'll hear from folks as to whether or not there might be a specific time frame to add a little bit of clarity to that requirement. And on cybersecurity generally, and kind of going back to that theme, but I'm going to look at it a little bit differently because I think sometimes we forget that we are also a target. We are also probably considered a valuable target to those who would like to infiltrate the government systems. And so we have to be mindful of not only our cybersecurity procedures, but the data we are collecting to make sure we don't have more information than we need. We need to keep it narrowly tailored so we can accomplish our mission. And August, you did a great discussion of how this reporting rulebook has kind of come together, working closely with the DCOs and developing and adding to this rule book. And I think that's great that you're working hand in hand with industry in that regard. Going back to some of these new fields, I guess one of the questions I did have is, are these fields, are these ones that you have had conversations with the clearinghouses as far as the need for this additional information? I know some of it's dates, a few other relevant fields, but are these fields that they agree would be helpful? I know some of them might already be reporting some of this information, but I would just be interested to know kind of what the discussion has been around these new fields that we're looking to add.
Right. The discussion around the new fields has been primarily internal, and that's given the posture of how we plan to treat the guidebook on a going forward basis. Changing it from a guidebook that's distributed by the division to the DCOs to a formal appendix to Part 39. So the new fields have not been discussed with the DCOs in connection with asking all the DCOs to report them on a going forward basis now. On a sort of ad hoc basis, yeah, we receive some of that information from some DCOs and on a voluntary basis. And there are, there's sort of been an existing ongoing dialogue between risk surveillance and the DCOs over the years. The staffers here and staffers at the DCOs, they'll pick up the phone and call each other and say, there's a problem with your data, or we're having a problem. We can't connect to you, Commission. And it's both technical and substantive. We think it's yielded an excellent result. And to I think the earlier part of your question, or the beginning of your question, this is all information that our risk surveillance branch thinks and they need to better surveil the DCOs themselves and the markets generally. Hope that's helpful.
Yeah, that's extremely helpful. And I think kind of just quick follow-up to that question. With some of the new data fields, and the need for this information to do appropriate risk surveillance, are we certain that there's nowhere else that this data is being reported to the commission? Is this going to be new information coming into the commission that we do not already take in through some other reporting requirement?
That's a great question. We're fairly certain. And the reason I say that is because we had some discussion internally where risk surveillance wanted something, and then it turned out that another division had it, but the other division didn't have it in the form that was most usable for us. And that was a little bit of debate internally. So yeah, we're extremely cognizant of whether both with respect to daily reporting and the other reporting requirements, particularly with respect to the commingling changes, whether any of the information that we're asking for is available either internally in a different division or is externally available. And then to the extent that it sometimes might appear that we are asking a DCO for a sort of type of data or a stream of data that also is publicly available. The reason we're doing that is because there may be like a handful of different versions of that data, depending on like who publishes it and or other reasons. And we want to know which version the DCO is using. And then if they're using it, they already have it. We feel like it's not a big ask to ask them to share it with us. So then basically we see what they're seeing, if that makes sense.
Thank you. And yeah, I agree. I think, as far as any data that is already out there publicly, asking it be submitted to us directly, to make sure we have the accurate data and that it's, in the format that we need is important. I just want to be conscious of new data that is, proprietary in nature, that would be very sensitive, that we're asking for, just to make sure that we are being careful and tailoring our requests. And because we are always under a threat as well. I think we do a great job. I think our cyber team does a great job here, but it's something that we should all be thinking about at all times. No further questions.
Thanks, Commissioner Mercinger, and I'll turn to Commissioner Pham for any questions she has.
Hello, and thank you again so much for your hard work on this proposal. I truly applaud staff's proactive approach in proposing solutions to a problem with our rules. Is staff confident the proposal will completely fix the reporting problem for DCOs previously mentioned?
Yeah, I think we are. If you're referring to the subject of the no action letter that was issued and extended, yeah.
Great, thank you. I'm pleased to hear that. And so now, will the staff have plans to withdraw the letter if the rules are finalized?
So I don't know if we would technically withdraw the letter or if we just specify in the rule that it would be superseded. But either way, on a going forward basis, the new rule would certainly take precedence, and there would be complete transparency and clarity for DCOs with respect to those particular obligations.
Excuse me, if I could just add, Commissioner Pham, that particular letter is actually going to have to be extended one more time because it expires in January, as August previously mentioned. So I think the idea would be we would extend it to expire either for a certain period of time or when this rule is finalized. So finalization of the rule would make the letter go away.
Great, thank you. I really appreciate the thought that you've put into planning this out. Is staff aware of any additional problems with the DCO reporting rules that could need to be fixed as well?
No, we are not. I mean, your question sort of ties back to the point I mentioned earlier about how the rulemaking evolved internally within DCR over time as we added new items that, as we sort of engaged in a fairly comprehensive review of the existing reporting infrastructure and requirements.
Thanks again so much. I really do appreciate how thorough you have been in doing that comprehensive review and in identifying issues where we could make our rules better. I noticed that the proposal also calls for additional amendments to our rules for DCOs, and some are relatively minor edits to the system safeguards rules for DCOs. Just for background, how long have the system safeguards rules been in place for DCOs?
I think 2011 or 2013.
Thank you. Have they ever been updated since then?
There was an update.
Yes, they were updated in 2016 was the most recent.
Great. So I'm pleased to see that we are continuing to update our rules as needed as we experience and have dialogue with the industry. Are there any additional areas where staff believes the rules might need to be updated in the coming over the next few years to reflect technological changes and innovation?
Not that I'm aware of right now, but please don't hold us to that. And it depends in part on sort of the nature and pace of the innovation.
Okay. Thank you so much again for all of your work on this. I truly appreciate it. No further questions.
Thanks, Commissioner Pham. Yeah. So we're going to, we reserve some time for essentially a second round. I don't have any questions, but we'll go in the order of seniority. So I will turn to Commissioner Johnson if you have any additional questions for the team.
Thanks so much, Chair Behnam, and kudos for keeping track of all of the rules of procedure as we navigate this meeting. I just have one final quick question, and in leading into it, I just want to applaud Commissioner Goldsmith-Romero's solicitation of comments regarding the timing element around this notion of promptly. I thought her careful reflections on the reality that, and Commissioner Mersinger's as well, the notion of promptly is a complicated one. And as a practicing lawyer, in drafting contracts, we would use as promptly as commercially practicable, but in a private ordering context, maybe that was sufficient. I certainly imagine Commissioner Goldsmith-Romero's reflections are accurate. We want to ensure, to quote August again, immediate information flows, if you will, from DCOs regarding system safeguards, compromising anything that compromises systems, system safeguards, and cybersecurity. My question about timing, however, arises in a different place and space in the proposed rule. So I'm thoughtful about 39.19C4, if I'm right, 15. And this is specifically with respect to the credit facilities, liquidity, funding arrangements, and custodian banks. Here, I think, if I rightly understand what has been done, that our goal is to tighten sort of a very similar, if not parallel, set of concerns to ensure that information related to the credit facility, liquidity, funding, and similar arrangements is reported out right away. As we can imagine from events this week and in recent weeks and over the last few months, particularly as my fellow commissioners have reflected on the salience of the growing digital asset ecosystem and liquidity crises and solvency crises that have emerged among these financial firms, there is certainly a need to have timely information flows from these institutions as well. So my question is actually just background. I'm applauding the proposed refinement here. My question is just background in terms of what the motivation might have been. I assume it's certainly the case you've been working for months on this proposed rulemaking. So the most recent events in the crypto asset ecosystem are likely not the motivating factors, even if they too, to the extent they are registered and operating within our markets under our purview, would be subject to such rules. So I'm curious to know what the impetus for updating and refining this particular rule might have been.
Yeah, the impetus sort of predated the recent market events that have concerned us all, and the basically we've expanded this this reporting requirement, which originally only applied to settlement banks, to include also custodian banks, and then two types of funding arrangements that DCOs can rely on. So we did it to ensure that basically it covers multiple types of reliance that a DCO has on the financial services banking and banking firms, where so it covers settlement banks, which process settlements and payments, custodian banks, which hold customer funds, and then it also addresses the resources that DCOs can lean on to satisfy their financial resources requirements, which are their liquidity funding arrangements and their credit funding arrangements.
August, this is fantastic to hear, in large part, certainly because recent market events really indicate the necessity of our adoption of prudential-like regulations and the information flows that will come to the commission directly from entities that are experiencing crises that may threaten their ability to honor commitments to counterparties, thereby creating concerns related to credit default, counterparty default, as well as their ability to remain resilient and to recover from incidents that might threaten the liquidity of the entities. Thanks so much for your response. That's my last question. Thank you, Chair.
Thanks, Commissioner Johnson. Turn to Commissioner Goldsmith Romero if she has any additional questions.
I wanted to thank the staff. I also thank Commissioner Johnson and Commissioner Mersinger for their words. I think we're all just trying to get this right? And we have these existing rules and we have what we've experienced, but we're also very much paying attention to the future because we are trying to create rules that can stand the test of time. And so we're all sort of looking at things as they evolve and making sure that we can evolve and adapt. And I appreciate you working with me in my office to try to accomplish that. And I appreciate the thoughts of all the commissioners on that same point. I know that's a goal for all of us. And the chairman has mentioned as well. So as we move forward and as we talk about things, I hope that we'll continue to look at things with an eye to the constant change and evolution we're seeing in threats and technology and market events, and that we are trying to make sure that we are considering all of that and providing the clarity that is appropriate, that will ultimately help those in the market and our registrants be able to know what our rules are and what our expectations are. And then is written in such a way where we can hold everyone accountable and through supervisory actions or through enforcement actions. And so I think I will always sort of look at things through that lens. And I'm very grateful that you are all thinking about those things as well. And I appreciate that you are trying to adapt and evolve your supervisory system and our rules to reflect those changes in that evolution. So thank you for your comments today. Thank you for your comments, each of the commissioners and the chairman today. I very much appreciate, and I take it all into account.
Thank you. Turn to Commissioner Mercer if she has any additional questions.
No additional questions. Thank you so much for all your hard work and for being willing to answer all of our questions today.
Thank you. And Commissioner Pham, anything?
No further questions. Thank you again.
Great. So having heard from each of the commissioners, if there's no further discussion or debate, we'll proceed to vote on the pending motion to approve and issue the notice of proposed rulemaking on reporting and information requirements for derivatives clearing organizations as presented in the voting draft. Are the commissioners prepared to vote? Yes. Okay.
Yes.
As it appears the commission is ready to vote. Mr. Kirkpatrick, will you please call the roll?
Thank you, Mr. Chairman. The motion now before the Commission is on the approval and issuance of the Notice of Proposed Rulemaking on Reporting and Information Requirements for Derivatives Clearing Organizations as presented in the voting draft circulated to the Commissioners. Commissioner Pham.
Aye.
Commissioner Pham votes aye. Commissioner Mersinger.
Aye.
Commissioner Mersinger votes aye. Commissioner Goldsmith Romero.
Aye.
Commissioner Goldsmith Romero votes aye. Commissioner Johnson.
Aye.
Commissioner Johnson votes aye. Chairman Behnam.
Aye.
Chairman Behnam votes aye. Mr. Chairman, on this matter, the ayes have 5, the noes have 0.
Thank you, Mr. Kirkpatrick. The ayes have it. The motion carries, and the notice of proposed rulemaking on reporting of information requirements for derivatives clearing organizations is approved to be issued by the Commission. With that, thank the team from DCR for all your hard work and your willingness to be here today and present an excellent presentation. Special thanks to August. I know you bore most of the weight, but certainly to the team and those, I'm sure, in the division and other divisions that supported this. So thank you very much. To continue with our agenda today, I would like now to invite staff from the Market Participants Division to make a presentation on the notice of proposed order and request for comment on an application for a capital comparability determination submitted on behalf of non-bank swap dealers subject to regulation by the Mexican Banking and Securities Commission. Presenting to us will be, as they are getting seated, Amanda O'Lear, who is the Director of the Market Participants Division, Tom Smith, Deputy Director of the Financial Requirements Branch in MPD, Rafael Martinez, an Associate Director in the Financial Requirements Branch in MPD, Carmen Moncada-Terry, Special Counsel on the Financial Requirements Branch in MPD, and Natalie Markman Radhakrishnan, Senior Counsel and Head of Supervisory Cooperation in the Office of International Affairs, who will be joining us remotely today. So welcome. And of course, thank you to all of the staff for being here today. And we look forward to your presentation. So with that, Amanda, I'll hand it over to you.
Good morning, Chairman Behnam and Commissioners. It is a pleasure to be with you today. I am joined at the table today by my colleagues, Tom Smith, Deputy Director, Rafael Martinez, Associate Director, Carmen Moncada-Terry, Special Counsel, and Justin's in the, okay, sorry, Justin was at the table and he's moved back to the front row. All of the Financial Requirements Branch of the Market Participants Division. I would also like to introduce 2 additional Financial Requirements Branch staff members who are with us today, Josh Beal and Justin McPhee. Josh, who is joining us remotely, and Justin, just behind us in the front row, are available to assist with responding to your questions should the need arise. Additionally, we are joined remotely by Natalie Markman Radhakrishnan, who is available to respond to any questions that might benefit from the expertise of our colleagues in the Office of International Affairs. Today, MPD is recommending that the Commission approve for public comment a proposed capital comparability determination and related order preliminarily finding that Mexican non-bank swap dealers that are registered with the CNBV of Mexico may, subject to proposed conditions set forth in the proposed order, satisfy certain CFTC capital and financial reporting requirements by complying with comparable Mexican laws and regulations. As we will discuss during the presentation, the assessment of the comparability of the swap dealer capital and financial reporting requirements of Mexico with those of the Commission involves substantial MPD staff resources. In this regard, I wish to acknowledge the efforts of Tom Smith, Josh Beal, Rafael Martinez, Justin McPhee, Jennifer Bauer, Larry Eckert, Carmen Moncada-Terry, and Lily Bozanova. I would also like to acknowledge the contributions provided by my colleagues in the Office of the General Counsel, including Rob Schwartz, Carlene Kim, Paul Schlichting, Mark Pfeiffer, and Jeanette Curtis, as well as the assistance provided by the Office of International Affairs, Suyash Paliwal, Mauricio Malara, Natalie Markman Radhakrishnan, and Jennifer Levin. I would further like to thank the commissioners and their legal assistants for your engagement with MPD on this matter, including your constructive comments and feedback on the proposed determination. I will now turn the presentation over to Carmen, who will present to you the proposed capital comparability determination for Mexico.
Thank you, Amanda, Chairman Behnam, and Commissioners. Staff of the Market Participants Division recommends that the Commission approve for public comment the proposed capital comparability determination and related order. The proposed determination and order will find that CFTC registered swap dealers that are both domiciled in Mexico and licensed with the Mexican Banking Securities Commission as broker dealers may comply with the CFTC capital and financial reporting requirements through substituted compliance with relevant capital and financial reporting requirements under Mexican laws and regulations. In adopting the Commission's capital rules for swap dealers and major swap participants, the Commission recognized that a substantial number of the non-bank swap dealers were domiciled in foreign jurisdictions and subject to home country capital and financial reporting requirements. To address potential dual regulation, the Commission adopted Regulation 23.106, which provides a system of substituted compliance. This regulation provides a mechanism whereby non-US, non-bank swap dealers may comply with home country capital and financial reporting requirements in lieu of the Commission's requirements, provided that the Commission finds that foreign rules are comparable to the Commission's rules and are intended to ensure the safety and soundness of the dealer. Regulation 23.106 provides that either a non-US swap dealer, a foreign regulatory authority with jurisdiction over a non-US swap dealer, or a trade association representing one or more non-US swap dealers may submit an application to the Commission requesting a capital comparability determination and order. The determination and order would allow non-US swap dealers to comply with home country capital and financial reporting requirements in lieu of all or some of the Commission's respective requirements. Regulation 23.106 further provides that the application for a capital comparability determination must include: 1, a description of the objectives of the relevant foreign jurisdiction's capital adequacy and financial reporting requirements. 2, a description of how that relevant foreign jurisdiction requirements address the elements of the Commission's respective requirements, including whether the foreign jurisdiction's capital rules are consistent with international standards, such as the Basel Bank Capital Standards. And 3, a description of the ability of the relevant foreign regulatory authority or authorities to supervise and enforce compliance with that jurisdiction's requirements. Regulation 23.106 also provides that the Commission will issue a capital comparability determination to the extent that it finds that some or all of the relevant foreign jurisdictions' capital adequacy and financial reporting requirements for non-US swap dealers are comparable to the Commission's corresponding requirements. In determining whether a foreign jurisdiction's capital requirements are comparable, the Commission may consider all relevant factors, including 1, the scope and objectives of the foreign jurisdiction's capital adequacy and financial reporting requirements. 2, whether the relevant foreign jurisdiction's capital adequacy and financial reporting requirements achieve comparable outcomes to the Commission's corresponding requirements for swap dealers and major swap participants. 3, the ability of the relevant regulatory authority or authorities to supervise and enforce compliance with the foreign jurisdiction's capital adequacy and financial reporting requirements. And 4, any other facts or circumstances the Commission deems relevant. Regulation 23.106 also provides that notwithstanding the Commission issuing a determination, foreign swap dealers remain subject to the Commission's examination and enforcement authority. The topic of today's discussion is a joint application filed by 3 entities: Morgan Stanley Mexico Casa de Bolsa, Goldman Sachs Mexico Casa de Bolsa, and Casa de Bolsa Finamex, which we refer to as the applicants. The applicants request a comparability determination with respect to each element of the CFTC bank-based approach, rules, and financial reporting rules with the Mexican requirements. The application describes the pertinent Mexican laws and regulations with relevant citations. With respect to the market participants' division process of reviewing the application, staff initially requested the applicants to complete a chart mapping the Commission's bank-based capital requirements and financial reporting requirements to the Mexican laws and regulations. The Market Participants Division staff also requested the applicants to provide English language translations of the relevant Mexican laws and regulations cited in the application. The staff then reviewed the Mexican laws and regulations and mapped them to the applicant's application. The Market Participants Division and the Office of International Affairs also held several calls with the applicants to discuss the application, and the division requested written responses to questions. The draft determination and order were provided to the applicants for the purpose of reviewing the factual accuracy of the division's description of the Mexican regulatory requirements and citations to Mexican laws and regulations. The Market Participants Division and the Office of International Affairs also had a conversation with the Mexican Commission to gain a better understanding of the Mexican capital and reporting regulatory framework and the supervisory process. The Mexican Commission made available staff of the Broker Supervision Division, which is responsible for the supervision of broker dealers, including Mexican non-bank swap dealers, so that they could discuss their supervisory process with CFTC staff. The Broker Supervision Division staff indicated that they use financial reporting with Mexican non-bank swap dealers from Mexican non-bank swap dealers as a component of the risk-based methodology for setting the frequency and scope of examinations of Mexican non-bank swap dealers. Defined risk-based metrics are used to assist in the selection of firms to be examined each year. Each entity is subject to examination, including on-site examination, every 2 years. However, the schedule may be accelerated if daily routine surveillance indicates the need for a more immediate review. Based upon the Market Participants Division's analysis, which I will discuss in further detail, the staff prepared a draft comparability determination and order, preliminarily finding the Mexican capital and financial reporting rules comparable to the CFTC capital and financial reporting rules, subject to certain conditions. With respect to the Market Participants Division's analysis, staff performed a holistic assessment of whether the Mexican Basel-based capital and financial requirements are comparable to the Commission's capital and financial reporting requirements. That assessment is reflected in the voting draft before you today, and to briefly summarize, finds the following. First, the fundamental capital structure and requirements of Mexico and the Commission's bank-based capital approach are comparable, and both are rooted in the Basel bank capital requirements. Specifically, the capital requirements of Mexico and the Commission are structured to require a swap dealer to maintain an appropriate ratio of qualifying capital to its risk-weighted assets. Second, both the Mexican and CFTC capital rules limit qualifying capital to capital that generally represents permanent equity of the firm and subordinated debt, where the debt holder subordinated the claims to the repayments to the claims of all other creditors. And finally, both the Mexican and CFTC frameworks provide the respective relevant regulatory authorities with overall appropriate information to adequately supervise and enforce the respective capital and financial reporting requirements. While the proposed determination contains a preliminary finding that the two regimes are comparable, the proposed determination also includes certain conditions, addressing, among other things, the absence of notice requirements in the Mexican reporting rules. In this regard, the proposed determination includes several proposed conditions with respect to reporting, including requirements for Mexican non-bank swap dealers to provide the Commission and NFA with monthly, quarterly, and annual reports. The proposed conditions also will require Mexican non-bank swap dealers to file regulatory notices with the Commission and NFA if certain defined events occur, including decreases in capital, the failure to keep books and records, and the failure to exchange regulatory initial and valuation margin in amounts exceeding defined thresholds. The proposed conditions on financial reporting and regulatory notices are necessary to allow the Commission and NFA to monitor Mexican non-bank swap dealers' ongoing compliance with home country requirements. The proposed conditions are intended to strike an appropriate balance between accepting home country financial reporting while also ensuring that the information received is adequate and timely for CFTC and NFA staff to properly monitor the capital condition of non-bank swap dealers. The proposed preliminary determination also requests comment on several specific questions with respect to the timing of the filing of the regulatory notices and financial reporting by Mexican non-bank swap dealers, and on the question of whether the Mexican capital rules adequately address operational and other risks without a provision requiring Mexican swap dealers to maintain a level of capital equal to or greater than 8% of the firm's unclear swap margin. Staff recommends that the Commission approve the proposed determination and order for public comment with a 60-day comment period. Thank you, and we are happy to take your questions at this time.
Thank you, Carmen, for that excellent presentation, and also mentioning the cross-divisional work and the cross-border work, the challenges of translations, cultures, and everything in between. So just a testament to, I think, the work of our staff, and certainly those of Mexican regulators as well to get to where we are today and hopefully consider this and move it along. So with that, the Commission will consider and vote on the proposed comparability determinations and requests for comment. To formally open the Commission's discussion and consideration of the first of those matters, I'll now entertain a motion for the approval and issuance of the notice of proposed order and request for comment on the application for capital comparability determination submitted on behalf of non-bank swap dealers subject to regulation by the Mexican Banking and Securities Commission as presented in the voting draft circulated to the Commissioners.
So moved.
Second.
It's been moved and properly seconded that the Commission approve the notice of proposed order and request for comment on the proposed comparability determination and issue it for publication. The floor is now open for the Commission's deliberations on this matter. I will begin with a few questions, and then we will go in order of seniority as we did with the previous matter. But before I start on my questions, a short statement about the matter and my views. Today's preliminary capital comparability determination for Mexican non-bank swap dealers is the second proposed order and request for comment to come before the Commission since it adopted its substituted compliance framework in July of 2020. I support the Commission's proposed order and request for comment on its preliminary determination that the Mexican non-bank swap dealers organized and domiciled in Mexico are subject to and comply with capital and financial reporting requirements in Mexico that are comparable to certain capital and financial reporting requirements under the Commodity Exchange Act and the Commission's regulations, subject, of course, to certain conditions set forth in the proposed order. As CFTC provisionally registered swap dealers operate and manage risk globally, the Commission's supervisory framework must acknowledge the realities of multi-jurisdictional operations. The Commission's approach to the proposed determination focuses on whether the Mexico Banking and Securities Commission's capital and financial reporting requirements achieve comparable outcomes to the corresponding CFTC requirements for non-bank swap dealers. Consistent with the Commission's authority to issue a capital comparability determination with terms and conditions it deems appropriate, today's proposed order contains 21 conditions. These conditions aim to ensure that the proposed order, if it's finalized, would only apply to Mexican non-bank swap dealers that are eligible for substituted compliance, and that these Mexican non-bank swap dealers comply with the Mexican Banking and Securities Commission's capital and financial reporting requirements, as well as certain additional capital, margin, position, financial reporting, record keeping, and regulatory notice requirements. I believe it's important to note that today's proposed capital comparability determination, again, if finalized, would not compromise the Commission's capital and financial reporting requirements. Instead, it recognizes the global nature of the swaps market with duly registered swap dealers that operate in multi-jurisdictions that mandate prudent capital and financial reporting requirements. As I have said before, a capital and financial reporting comparability determination order of this kind is not a compromise, and it's certainly not a deference to a foreign regulatory authority. The Commission would retain its enforcement authority and examinations authority, as well as obtain all financial and event-specific reporting to maintain direct oversight of non-bank swap dealers located in Mexico. Look forward to the public submission of comments, as always, and feedback on this proposed determination and order. And as always, and as I've said before, thank you to the hardworking staff of the Market Participants Division, those who are here and those who are with us virtually, for all of your efforts to bring us here today and supporting the Commission staff in ensuring that we get this right and put it out for public comment and hopefully move forward. Again, acknowledgement to MPD, but also the OGC, Office of General Counsel, and of course, the Office of International Affairs. So with that, two questions, perhaps for you, Carmen, but Condition 7 within the order, and I kind of want to talk about non-bank swap dealer internal models and how we review them. So Condition 7 would require Mexican non-bank swap dealer to provide the Commission, and as you mentioned, the NFA with notice, should it seek approval of the Banking and Securities Commission to use an internal model to compute market risk or to manage credit risk. What's involved from our perspective in terms of reviewing that risk model and ensuring it complies with our requirements here in the US?
Thank you, Chairman. Very good question. Basically, under the Mexican regulations, swap dealers can only use models to calculate market risk charges in computing the risk-weighted assets. They cannot use modeling for credit risk to calculate credit risk charges. We have experience already considering modeling in connection with the Japanese application that we recently considered back in July. Along the lines of the analysis we conducted with respect to the Japanese application, we will, if a swap dealer were to announce that they want to use models and they're seeking approval for a model, we will consider the Mexican framework for approving modeling for market risk. And we also will consider its consistency with our rules, in particular Rule 23102 and banking rules, in particular Rule 12 CFR 217. In addition to that, we will also consider whether we will need to condition relief on providing the monthly modeling metrics that are required under Regulation 23105K. I believe that my colleague, Rafael Martinez, might want to add to what I just said.
Thank you, Commissioner. If Mexican swap dealer decided that they wanted to use models for market risk and informed us of that intent, we would probably, first, it just increases my work materially. This had been the easiest comparability determination we've engaged, and since they didn't approve models. But if they did apply for models, we would probably have to engage with the Mexican regulators much more intensely, because it would not just be looking into the rules. It would also be looking into the governance structure of the firm and how the supervisors and how exams take place. As you know, I've said this, you probably heard me say this, that we don't really approve models as much as we approve the modeler. It's much more not whether the model is good, because our models will eventually fall behind or fail. It's their reaction to that. And if somebody is going to be aware that something may not be working well, and how they would repair the model to make sure that the level of confidence that they have sufficient assets to withstand any shock that are available, right? And so we are lucky that Mexico is an active participant and follows closely the Basel regime. And so there are a lot of similarities that I would expect in the way they would review and they would supervise models. But we would need to engage with the regulator because a lot of the communication of expectations of a regulator with respect to models are not in rules, they're in guidelines. And that's true in the US and that's true worldwide. And we just need to review those as we did with Japan.
Thanks, Rafael. And thank you, Carmen, for that response as well. Quickly, second and final question, condition 9, this might be for Tom regarding capital. The month-end capital report and the information that we received from the Mexican non-bank swap dealer. I think help us understand a little bit, but what does that do from your perspective in giving you comfort, but also meeting the requirements and giving you a sense of the risk associated with the entity?
Yeah. So currently under the no action letter that we have for the non-U.S. jurisdictions for capital, they are providing that information to us. So today we are receiving month-end capital computations from the 3 Mexican entities. Under their rule structure, they provide that information on a quarterly basis to the CNBV, and we wanted to continue to receive it on a monthly basis because it's showing us their ongoing capital compliance on a month-to-month basis. So that's basically the reason why we were able to see any changes on a more frequent basis. And it also ties into some of the notice provisions that we have, where if they had less than 120% of the minimum requirement, that's sort of an intra-month requirement as well. So the idea in the capital space is we'd like them, of course, to be in compliance at all times, and we get information to the extent that they are experiencing any issues with the decline in their capital levels.
Thanks, Tom. And just a little bit of a dovetail off that, you mentioned obviously the existing no action relief. My assumption is if finalized, this order would eliminate the need for the existing no action relief.
Yes, the way the no action letter is currently drafted, it expires for each jurisdiction by October 1st of 2024 or the earlier of the issue of a final determination by the Commission.
Great. I think another example of the Commission taking action and with support from staff, of course, of eliminating some of these outstanding no action letters. So again, thank you to staff for the answers, for all the great work, and looking forward to certainly questions from my colleagues. And with that, I will turn it over to Commissioner Johnson for any questions she has.
Thanks so much, Chair. Thank you all so much for this wonderful presentation and for your thoughtfulness in preparing the notice and order on Mexican capital comparability determination. I support the notice and proposed order, commend the staff's hard work on this matter and your meticulous review of the capital and financial reporting requirements in Mexico. I applaud the continuing collaboration among Commission staff and counterparts at de la Comisión Nacional Bancaria de Valores in Mexico. I have no doubt this was a full team effort, not just all of MPD, but also OGC, the Secretariat in many ways. We would be lost without you and OIA. The Commission's capital and financial reporting requirements are critical to ensuring the safety and soundness of our regulated swap dealers. Ensuring necessary levels of capital, as well as accurate and timely reporting about financial conditions, helps to protect swap dealers and the broader financial system from shocks, thereby ensuring resiliency. Prior to the adoption of the CFTC's final rule regarding swap dealer capital, which was published in the Federal Register on September 15, 2020, with a compliance date of October 6, 2021, the Commission had issued interpretive guidance allowing for substituted compliance determinations to be made with respect to other components of the Commission's swap dealer requirements. Under that guidance, the Commission had issued comparability determinations relating to market participants operating in several jurisdictions, including the EU, Australia, Canada, Hong Kong, Switzerland, and Japan. The proposed order before the Commission is our second capital comparability determination and a first for Mexico. When the Commission initially issued interpretive guidance, many jurisdictions had not yet implemented swap reforms. Today, many jurisdictions have. And I am excited to note that we are taking steps necessary to move this notice and order forward. I support acknowledging market participants' compliance with the regulation of foreign jurisdictions when the requirements lead to an outcome that is comparable to the outcome of complying with the CFTC's corresponding requirements. Substitute compliance must not, however, be confused with deference. To the contrary, the swap dealers that qualify for substitute compliance under Regulation 23.106 must be Commission registrants. The proposed order, if approved, would continue to ensure that relevant Mexico-based swap dealers are subject to the Commission's examination and enforcement authority. Capital requirements play a critical role in fostering the safety and soundness of financial markets. As indicated in the CEA, capital requirements protect market participants against risks such as counterparty default. Robust capital requirements enable capable individual market participants to absorb losses, meet their obligations, and successfully navigate challenges that may threaten their integrity or trigger systemic risk concerns. I just have a few questions for you all today, and I'm hopeful that with your responses, which I anticipate will reflect how hard you've worked over the course of several months in preparing for today's open meeting. While Japanese comparability determinations considered earlier this year were made by the relevant foreign regulator, the JFSA, the application here has been made by swap dealers domiciled in Mexico. While our rules allow for a comparability application to be made by swap dealers seeking the benefit of a comparability determination, any such determinations by necessity require extensive discussions with and cooperation from a foreign regulator. In this context, again, la Comisión Nacional Bancaria de Valores. Can you explain MPD's strategy for ensuring the necessary level of cooperation with CNBV and the discussions that may have transpired, as well as any efforts to ensure we properly understand Mexican regulation and that it is comparable to regulation that we would have adopted?
Thank you, Commissioner. I will answer the following way, but my colleagues, I might turn to my colleagues as they might want to add to what I might have to say. We have had very productive conversations with our counterparts in Mexico, the Mexican Commission. We had two very good phone calls, most recently a phone call right after the consideration of the Japanese application. It was in August, it was on August 10, 2022. And on that phone call, we conveyed to them that we were considering an application that had been submitted by three entities: Goldman Sachs, Casa de Bolsa, Morgan Stanley, Casa de Bolsa, and Casa de Bolsa Finamex. And we explained to them the applications. We also described to them our process. We also described to them what we were intending to do. In turn, they were very helpful. They had available during this call everybody who is involved in the supervision of broker-dealers, including Mexican swap dealers. In particular, we had a conversation with the Division of Broker Supervision, and they explained to us in detail the process for overseeing Mexican swap dealers. They told us that they basically carry out a risk-based methodology for determining when and how often to examine entities. Each entity basically gets examined every 2 years. However, if daily surveillance indicates that the schedule should be accelerated, it will be accelerated. They have the broker supervision division has 3 teams. They oversee 36 entities. Each team takes care of 12 entities, oversees 12 entities. And they were just very, very helpful, very descriptive as to how they conduct their oversight.
Thank you, Carmen. I'm happy to hear from anyone else. That was very helpful.
I'll add a couple of items just to round out what Carmen had said. In looking at the regulations, we didn't just rely on their mapping of Mexican law and regulations to the commissions, but they did that for us. They also provide us English translations of the Mexican rules and regulations, but we also went beyond that to ensure that the translations were complete, in the sense that we're fortunate that we have the capability of reading the Mexican rules in Spanish and comparing that to what they had told us. And many of our sort of detailed follow-up questions were not initially covered by English translation. So we dug deeper into different documents that we were able to obtain either directly or indirectly, and sometimes by just going directly to the website of the CMBV and looking at certain things to, fulfill all of our responsibility, making sure that we understood their regime. So that was in addition to working closely with the applicants. They answered a lot of our questions. And then, as Carmen described, our communication directly with the CMBV.
If I may add, under the rule, we allow the application to come from our regulator, from the firms, and I wouldn't want it to the impression to be out there that there's one application is stronger because it comes from the regulator than the other that comes from the applicants. I think it's probably on a case-by-case basis. And in the case of Mexico, we had a lot more access directly to the firms themselves, and that was good for some things, right? And we had more access, say that with the case of Japan, right? There's might be culturally, it might also have to do that the JFSA, the conversations went beyond the comparability determination for the swap dealers in Japan that were non-bank. They were also discussing other aspects, for example, of reporting requirements by bank swap dealers. And so the regulator was natural. The regulator was the person we were interacting with. If the situation had been one in which we were approving, looking for comparability as well as of model oversight, we probably would have had a lot more interaction with the regulator directly, because it involves, as I mentioned before, how they supervise over the model. But that's not the case when they're using standardized charges. It's almost self-explanatory from the rules. And so I just want to note, we had access to the risk officers and compliance officers of the firm that were very responsive to accountants. And we got what we needed. And in no way was one application more robust in one country than in the other, because there was a difference in the applicant. At least that's my sense.
That's tremendously helpful. Thank you, Tom, Amanda, Carmen, Rafael, and Justin, and all of those who have stood behind you working for months on this in MPD. I'm also just elated to hear of the effective cooperation and collaboration with the Comisión de Valores Bancaria de Valores in Mexico. It's always encouraging to hear about this level of cooperation. So thank you for your thoughtful responses to my question.
Thanks, Commissioner Johnson. Turn to Commissioner Goldsmith-Romero.
Thank you. That's very impressive, Commissioner Johnson. And I will refer to them as CMBV and leave it to Commissioner Johnson. I want to echo something that the chairman said and Commissioner Johnson said as well about how today's preliminary determination is not a compromise of the Commission's capital requirements and is not deference to a foreign regulator, and that the CFTC would maintain direct oversight of the swap dealers in Mexico. And I very much appreciate your hard work in ensuring that is the case. I'm really grateful for all of your engagement with my office and me and with working on changes on the proposed determination. As you know, I care greatly about the need for strong capital requirements given my background in financial stability. And I appreciate the question and answer that that just happened about the swap dealers requesting this determination. And while I appreciate the answers, it's the further engagement with the regulator that gives me confidence, not only that we have a sound preliminary determination, but it's about what happens going forward, right? It's about making sure that something happens, someone becomes undercapitalized or there's some other concern, that we have the right coordination, that we have the right engagement. And so in addition to giving me confidence about how the CMBV was very helpful, as you said, Carmen, in giving you this information and talking about their approach, in addition to that, helping us make sure that we make a sound determination, what's most important is that communication and that global coordination. So I'm very grateful for that. I was going to ask about the regulator's approach to supervision, oversight, and enforcement, but Carmen has done such a good job explaining that in her opening and in response to Commissioner Johnson's question. So I really just kind of I do want to ask about one of the things that's most important to me. I'm a strong supporter of keeping the CFTC's requirement for a minimum 20 million in common equity tier 1 capital, which is one of the strongest, most high quality types of capital. I'm glad to see that you are conditioning the preliminary determination on requiring the swap dealers to comply with a $20 million minimum requirement that the CFTC has. I know in the determination, you determined that fundamental capital under Mexico rules would compare to common equity tier 1 capital. And so can you describe what fundamental capital is and under the Mexican rules and how that compares to common equity tier 1 capital?
Fundamental capital essentially is common equity tier 1 capital. The Mexican approach, I would say, is a little bit more conservative in the sense that under Basel and under our rules, common equity tier capital includes common equity instruments, retained earnings, surplus, comprehensive accumulated income. But under the Mexican approach, it only includes common equity instruments and retained earnings. And furthermore, they deduct anything that could have an impact on those instruments. And we actually recently, as noted by Rafael, we have had very good communications with the applicants. And we got actually clarification from one of the applicants that was very helpful. The approach that Mexico takes, it's very much in line with the Basel approach. Basel actually provides for the applications of regulatory deductions, which are basically represented in the Mexican approach.
That's the perfect answer. That's exactly what it's absolutely answered what the question that I have. And I appreciate you saying that they take a more conservative approach, and particularly about those deductions. There's sort of a growing interest in capital issues right now about whether those deductions should be taken. So I appreciate you explaining not only that they take a conservative approach, but that they are accounting for those deductions. I want to talk a little bit about the notice requirements and what are the types of events that the commission needs to be notified of, and why, in your view, it is important to require the Mexican non-bank swap dealers to comply with these notice requirements as a condition.
We require notices when the swap dealer is undercapitalized or fails to meet certain defined thresholds. We are also required notices when the swap dealer fails to maintain current books and records. Further, we also require notices when there's a failure to exchange initial and variation margin. We believe that notices are critical aspect of the CFTC's obligation to assess the financial condition of swap dealers and their ability to absorb losses associated with their swap activities. We have, as you noted, the Mexican approach doesn't include notices. So we are basically requiring the Mexican swap dealers to rely with that are relying on substitute compliance to comply with the whole array of notices that are required by 105. I cannot recall the subsection right now. In any event, and also we are raising some questions concerning the condition to provide the notices. We are asking questions concerning the timing for providing the notices, and in order to, we are asking whether the timing, which is within 24 hours of learning of the event, to whether that provides sufficient time to the Mexican swap dealers to translate the information into English, and if there are any amounts to convert them into US dollars.
Thank you for that, and I appreciate the additional changes too. We had on the notice requirements and what went in there, and having the capital information. I very much appreciate that. I appreciate you talking about the timing of the notice and the question about whether within 24 hours of learning the event, whether that's sufficient. And I look forward to public comment on all these issues. Following this up, if I know here we don't have a supervisory memorandum of understanding that would apply here, like we had a cooperative memo with Japan. So how do you envision sort of the engagement and cooperation with the Mexican authorities? Should there be playing it out, you get a notice from one of the swap dealers, you see something in the financial reports that indicates a potential issue or concern, or at least a question. And so how do you envision that working with the regulatory counterparts in Mexico?
If we were to get a notice concerning undercapitalization, for example, we will basically first talk with the swap dealer, and we will discuss concerns relating to the counterparties, how to deal with the counterparties. Then we will also engage the Mexican Comisión Nacional Bancaria de Valores y de Valores, and we will contact them, and we also will engage the swap dealer, and we will discuss what steps to take concerning how to bring back the swap dealer into compliance, and if that's not possible, how the swap dealer could reduce its exposures such that the capital requirements will be reduced. So that's what we at this point. It's a very fact-specific situation, and it will be at this stage. It's difficult to specifically say what will happen, but it will be very fact intense, and we believe that in light of our conversations with our Mexican counterparts, that we will able to address the matters there adequately and appropriately.
Thank you. I appreciate that. That's and I appreciate that it would be fact specific. I think the two main takeaways is that we would continue with our direct oversight, but that we would be in constant communication and coordination with the foreign regulator, and that's the most important thing. So thank you. I'm very supportive of the preliminary determination, and I don't have any further questions. Thank you very much for your hard work.
Thank you, Commissioner. Turn to Commissioner Mercinger for her questions.
Thank you all for working on this. I can only assume that this was tedious and time consuming. And I appreciate all the hard work everyone has put into this. I also think that it's amazing that we have such talented bilingual individuals in our market participants division to really make sure this project, is done to the best of our abilities. So we're very fortunate to have individuals that can help in that sense as well. And really, my question is more of just a functional question. If the regulations in Mexico were to change, whose responsibility is it to notify to either notify the commission, or what's the process for changing the determination or addressing the determination if there's some sort of change in the regulation of the home country that would change how we view the determination we've made?
Carmen, I can start on that one for you. So the determination itself and the order requires the applicants to notify us any material changes in either the laws or supervision that's conducted by the CMBV or the laws of Mexico. So that would be the first way first obligation. But we also envision that we would have continuing conversations with the CMBV, and we would raise things like that. I think they have an interest in hearing from us, because these are important institutions in our jurisdiction as well. So they're interested in understanding what we're seeing with respect to the firms themselves, and plus our regulatory structure and laws and how they're changing. And we've sort of had that preliminary conversation that we would like to understand the same thing from them. So I think there'd be an ongoing dialogue with the CMBV.
Well, that's great to hear. And if there were changes that needed to be made, the process for that, is it going through the whole process again? Are you able to make the changes as needed within the determination? What would be the process on our end at the commission if there was some sort of change like that?
I think the way the document is drafted now, it provides that it may result in a need for an amended order. So I guess it would depend on the materiality and what the issue was. And if there was a need to do an amendment, I think we would have to do it through a similar process. I'm not certain. I'd have to talk with my colleagues in OGC and the commission's decision itself. Would they want a proposal again, or could we just go ahead and make an amendment to an order that the commission would approve?
If I may, the regulations in Mexico, same as in the US, for capital, tend to be derived from the Basel Agreement. And one thing I can say about the Basel Agreement and the implementation rules is that it's not fast. And so generally there's a lot of lead time, and multiple jurisdictions try to coordinate when it's that they're implementing certain changes. And it's very likely that if we were to receive a notice of changes in the Mexican way of calculating risk-weighted assets, we would be involved in something similar ourselves. And we would have the Federal Reserve doing the same. So it would affect swap dealers that are following the bank-based approach with us. And it'll be a question almost like, what are the variations in each jurisdictions from what the Basel framework is asking for. Luckily, some of the more difficult changes happen in models, and Mexico is not approving models. And with the upcoming changes in Basel that people are implementing now, so SACR starting in, there's some portions of it already announced for January 1st, 2025. So usually it's years of lead time. Let's just say that they're less friendly to modeling, and less likely that any jurisdiction that doesn't allow models now is going to see models emerging anytime soon. But it would be a global coordinated effort, generally in the same direction.
Thank you. That's really helpful. And I think it proves the point that this is not a one and done deal here, that this is we're going to continue to be very involved, that we are not just simply, kind of nodding our head to the foreign jurisdictions regulations and then we are hands off. That's not at all the approach here. And I think that's really important for everyone to know as we go through these determinations. So thank you again for all your hard work in getting this together.
Thanks, Commissioner, and turn to Commissioner Pham for any comments.
Thank you, Chairman. And thank you to the staff for being here today. I respectfully concur with the notice of proposed order and request for comment on an application for a capital comparability determination submitted on behalf of non-bank swap dealers, subject to regulation by the, I don't think I'm going to do this as well as Commissioner Johnson, Comisión Nacional Bancaria y de Valores, because I don't speak Spanish. Today's proposed order and request for comment on a comparability determination for 3 non-bank swap dealers by the Mexican CNBV marks yet another important step for cross-border harmonization. It is worth reiterating the progress that the world has made since the 2008 financial crisis in implementing this, among other G20 global derivatives reforms. I would like to thank the staff in the CFTC's Market Participants Division for their hard work, continued engagement with our global counterparts, and commitment to providing substituted compliance to continue implementing these reforms. The proposed determination and order would permit, subject to several proposed conditions, CFTC registered non-bank swap dealers domiciled in Mexico to satisfy certain commission swap dealer capital and financial reporting requirements via substituted compliance with certain capital and financial reporting requirements. CFTC staff met with Mexican CNBV staff on several occasions to discuss the application process and capital and financial reporting requirements. I'm pleased to see that there was such successful collaboration and cooperation with our international counterparts. One of my guiding principles throughout my career, both as a regulator and in the private sector, is that markets work best when there are clear and simple rules with common standards. Ensuring that these rules are harmonized minimizes operational complexity that can otherwise increase risks and costs. Without an approach that appropriately recognizes the home country regulations, trading and clearing becomes more complex and therefore costlier and less efficient for all market participants. Through the hard work of MPD, today's order takes a step in mitigating these potential negative effects on the global and U.S. markets. I am also pleased that the proposed order recognizes that Mexico has implemented rules that are consistent with the Basel Committee for Banking Supervision's framework for international bank-based capital standards. We must continue to appropriately adhere to international standards because our markets are global and we are not regulating in a vacuum. I continue to believe that the CFTC should take an outcomes-based approach to substituted compliance, one that strikes a balance of both recognizing the nature of cross-border regulation of global markets and that preserves access for U.S. persons to other markets. From my hands-on perspective implementing policies, procedures, and processes to comply with our rules, I welcome comments, particularly on any operational issues with additional reporting requirements, given local governance and regulatory requirements, differences in financial reporting, or anything else anticipated by market participants. There's just one small example that I wanted to mention. Specifically, I am unsure how an entity can file a notice within 24 hours of when it, quote, should have known, end quote, about a books and records issue. When you are designing an escalation and self-reporting process and have to start the clock ticking, either you have identified an issue or you haven't. There is a specific time, and then the deadline is 24 hours later. I am not sure how you can count 24 hours from should have known because there is no specific time from which to start the clock ticking. Perhaps we mean knows or reasonably suspects that there is an issue. That is one of the reasons why I am concurring in today's proposal. Nonetheless, I very much appreciate the careful consideration by the staff and the Commission of how to take a practical approach to achieve appropriate oversight and mitigation of risk to the United States and the markets. Thank you.
Thanks, Commissioner Pham. We, like the first matter, we reserved questions second round, so I don't know if there are any questions. So go to Commissioner Goldsmith-Romero.
Can I ask about what Commissioner Pham just said about the timing, the 24 hours from should have known? Can you address that?
That is consistent with what's in 23105 for U.S. entities, as well as how the FCM rules have always been sort of written. And yes, it is a when you know or should have known standard that we followed with respect to certain of the notice provisions, such as being undercapitalized, and it gets into a very fact-specific situation. What we don't want is a situation where, an issue, it sort of comes in attention with, like, as you were just discussing on the previous panel, with immediate or promptly. It's not a clear standard. I agree with that. It's an idea, though, that at a certain point in time, a regulated entity understands that they have an issue, or they should have known, but their systems have failed to identify that. So it's sort of looking at that in that type of context. But I think it's sort of it's a fact-specific analysis.
And so how do you hold them accountable to that, and whether through supervision or enforcement?
It hasn't been an issue that's come up extensively, and usually the firms know about it. So it's not an issue of whether or not they notified us within 24 hours of knowing it, because I don't know if we have a real example of when the commission has said you should have known about that. It's they did know about it, if you follow what I'm trying to say. They've been together. So it's not like there was issues where we have ever taken an action or enforcement case against, that I'm aware of, against an entity that was, for instance, undercapitalized for a period of time, but they didn't realize that they were undercapitalized for that period of time.
Okay, thank you. I just want to follow up on something the chairman raised about modeling, and also Commissioner Mersinger. And I'm very glad they're not using modeling. And thank you for including the language we have, like if that should change, that's something we would have to readdress. And I take Commissioner Mersinger's point on that. I mean, I do think the use of modeling changes things, and I appreciate you talking about how it's not allowed, and talking about how modeling is being looked at right now. And it's just something to sort of have in the back of our minds. I'm glad we would be getting notification of that should it change, so that we could then determine how we wanted to address that, and in whatever capacity. And if that should change, I would of course be very interested in engaging further on that. Thank you.
Thank you, Commissioner. Anything from Commissioner Mersinger? Commissioner Pham, do you have any additional questions?
Yes. I'm always interested in providing greater clarity for our rules. And so with my comment and some of the questions from Commissioner Goldsmith-Romero, I understand what our rules are trying to get at. And might I suggest that perhaps in this instance with our rules, as well as with the order, which is again consistent with our rules, perhaps we mean when it knows of an issue or potential issue, or when it reasonably suspects that there is an issue. And so that's just a suggestion that I might provide. Regarding my other questions, I was wondering if we have additional applications for substituted compliance pending, and what the status might be of that, and do we expect any more applications in the next 12 to 18 months?
We have two jurisdictions that have filed applications for substituted compliance. The European Union, we have swap dealers in France and Germany. They're subject to the European Union application. And then the United Kingdom. We have started looking at those applications. We're working, and the way we did this was we worked on the first ones that came in. We tried to get to them as quickly as we could. First one in was Japan. Second one in was Mexico. And We are actively working on the other two, and we've done more work on the European Union than the UK. That's just sort of as they came in again. As you can tell from our presentation and who we mentioned, they're very labor intensive on our part. So it's really just a question of bandwidth of getting to them. And we hope to, as you're aware as well, we extended the no action letter for those jurisdictions till October 1st, 2024, just so that we thought that was adequate time to finalize all four of them. We don't expect any additional applications beyond those four at this point in time.
Thank you very much. And again, I do commend you for dealing with very voluminous and complex rule sets from multiple jurisdictions and the hard work and analysis that goes into that process.
Thanks, Commissioner Pham. And given the conversation, I think we'll hope for a comment from the public on specific language and how it impacts registrants and their ability to react and report incidences to us in a timely manner that's both reasonable and practicable, but not too flexible. So I think that's what we're all trying to achieve. So with that, having heard from each of the commissioners, if there's no further discussion or debate, we'll proceed to a vote on the pending motion to approve and issue the notice of proposed order and request for comment on the application for capital comparability determination that was submitted on behalf of non-bank swap dealers subject to the regulation by the Mexican Comisión Nacional Bancaria de Valores as presented in the voting draft. Are the commissioners prepared to vote? It appears the commission is ready to vote. Mr. Kirkpatrick, will you please call the roll?
Thank you, Mr. Chairman. The motion now before the commission is on the approval and issuance of the notice of proposed order and request for comment on the application for a capital comparability determination submitted on behalf of the non-bank swap dealer subject to regulation by the Mexican Banking and Securities Commission as presented in the voting draft circulated to the commission. Commissioner Pham.
I concur.
Commissioner Pham concurs. Commissioner Mersinger.
Aye.
Commissioner Mersinger votes aye. Commissioner Goldsmith-Romero.
Aye.
Commissioner Goldsmith-Romero votes aye. Commissioner Johnson.
Aye.
Commissioner Johnson votes aye. Chairman Behnam.
Aye.
Chairman Behnam votes aye. Mr. Chairman, on this matter, the ayes have 4 and there is 1 vote to concur.
Thank you, Mr. Kirkpatrick. The ayes have it. The motion carries, and the notice of proposed order and request for comment on the application for a capital comparability determination that was submitted on behalf of non-bank swap dealers subject to regulation by the Mexican Comisión Nacional Bancaria de Valores is approved to be issued by the commission. So having completed the planned agenda items for this meeting, I believe we are ready for closing remarks. We'll start with Commissioner Pham and go up in order of seniority. But before that, again, a special thanks to Amanda and the entire team, those here, and I know some who are with us remote, certainly those from OIA and OGC as always, for your work. I think as recognized by all the commissioners, unique element of our job and responsibility at the commission, and the success that we've had, I think is a demonstration of the quality of our professionals and our ability to work in a productive, cordial way with our counterparts across the globe, and demonstrates the importance of our markets on a global basis. So thanks again to staff at NPD for your work and your contributions today. So with that, I will turn to Commissioner Pham for any closing remarks.
I would like to just again thank my team and all the staff of the CFTC, both those who presented today as well as prepared and ran this open meeting. I also want to thank my fellow commissioners and the chairman for the discussion and deliberation. Thank you.
Thank you, Commissioner Pham. Commissioner Mersinger.
Just to echo the thank you. I know a lot of hard work went into today's meeting, and certainly appreciate all the hours folks spent on putting these the rules together and the comparability determination together. And just also really want to say thank you for taking the time to work on issues that do bring some certainty to the market, so that we are not relying on kind of perpetual no action letters in these spaces, and we're able to show commission action to ensure that we are dealing with this moving forward. So I greatly appreciate that. Thank you.
Thanks, Commissioner. Commissioner Goldsmith Romero.
Thank you, Commissioner Mercinger, for acknowledging the loss of Captain White. I will tell you, he made me laugh every single day. And he, like me, also just had a grandson a few weeks back. And so we were comparing pictures literally every day. And so I am very grateful for his service, and I feel his loss. I really want to thank the chairman and my fellow commissioners. This is a really good opportunity for us to listen to each other and realize how many of the same things we care about and are concerned about. And it's really great to have this forum, and it's really a privilege and honor to serve with you. I want to thank you to the staff. You've been so engaging and patient as we ask a lot of questions that you have deep expertise in, and we are relying on very heavily. But you give us confidence that we can rely on you, and I appreciate your being open and willing to listen and work with us. And I want to thank all the staff who worked on this meeting today, but to all of our staff, not just the staff who worked in the open meeting today. You are the heart and soul of this commission, and it's critical of this commission, its critical mission to markets, the American public, and with the impact on the world. And I am grateful for that. Could not do my role without that. And I just want to thank you. You probably don't get enough thanks. And so here's this opportunity to thank you, not just for what you did with all the work leading up to today, but for all that you do every day. And this goes out to all CFTC staff. Thank you.
Thank you. And Commissioner Johnson.
Thanks so much, Chair Behnam. I want to echo the thanks offered by Commissioners Pham, Mercinger, and Goldsmith Romero. I also am so grateful for Commissioner Mercinger's acknowledgement of Veterans Day upcoming and our community's loss in this respect. I shared earlier this week that in our family, my mom's only brother, my grandparents' only son, voluntarily enlisted to serve during the Vietnam War, and not only once, but he served 2 tours of duty. And I described that he had to escort the body of his childhood best friend home in the midst of the first tour of duty. To me, that is sort of the level of service and commitment that I aspire to demonstrate every day. And I see it in all that you all have done here today in preparation for today's meeting. So thinking about the importance, the salience, the sacredness of the service of our veterans, I hope to emulate that. And I really am inspired by your efforts. And I want to be thoughtful, not just about each of the divisions that came and presented, but I want to just acknowledge ITAV, the many people who were here that I could see yesterday when I was viewing the room from afar, setting up plants and putting out chairs and photocopying and leaving documents and binders, faces that often aren't seen on camera, that may not be captured even if we read the roll call of full-time employees of the agency, many contract workers who support us in the execution of our duties. So up and down the roll, I just want to acknowledge and thank everyone who contributed to make today's meeting possible.
Thanks, Commissioner Johnson. And I think this is a demonstration why this commission is so great. They make my life easy. So I'm not going to try to repeat all the great things that were said, but thanks to the whole commission, and as again, acknowledging Veterans Day tomorrow and as we're approaching the holiday season, it's special to be back in person and to be here on the dais and to engage and to see everyone in person and to do the business of the commission so that the public can appreciate your hard work and the importance of this agency to markets and the economy, especially at a time where we're facing a lot of issues on geopolitical front, macroeconomic front, and a lot of other uncertainties. So again, thanks to everyone for their work, their commitment, and for your presence today. It's important, I think, for all of us to see and to be present with each other. So with that, with no other business, I will call this meeting. It is now adjourned. Thank you.